are your top stories. Stocks drop. The dollar rallies after Fed hawks Loretta Mester and James Bullard signal support for steeper rate hikes. China's top tech banker Bao Fan goes missing, fueling speculation of a renewed government clampdown on the financial industry. Plus, the Munich Security Conference begins today against a backdrop of Russia's war in Ukraine and the response by NATO and other allies. So, TJIF, it is Friday. We still have quite a lot of news to get through. This is a future picture. If you look at European stocks, a little bit, well, actually quite a lot of pressure, down 0.8%. Now, this is after we had two hawks on the FOMC speaking to Bloomberg yesterday, saying that, look, expectations of steeper U.S. rate hikes are definitely growing. So we heard from them, look, the fight against inflation is not done yet. And we also heard from Isabel Schnabel, one of the most powerful executive board members on the ECB, also in charge of markets, saying markets are also underestimating their fight against inflation. Now, the picture overall for equity indices, as they're starting to open, is probably one of risk off. Yesterday, remember, was one of risk on. A very interesting analysis also from Mark Cudmore, that it's not because of a move in yield that equities do the same thing. You have to think about why yields are moving to see whether equities go up and down. So this has changed in the last couple of weeks. Foreign exchange, we'll look at British pound. We seem to be closer to a deal on the Northern Ireland Protocol. That's not 100% a done deal, but we have our team on the ground really trying to break that for us. And then the other stories, of course, commodities. Iron ore a little bit up, and we're seeing a bit of pressure on oil after inventories were better than expected. Right, cross asset, we look at dollar, one of the biggest important stories in today's trading session. It did rally. I'm also looking at the 10-year Treasury yield near the highest this year. So that's a picture for a cross asset. We'll get to that in a second. We talk about, of course, the UK quite extensively. But also, let's get over to our Bloomberg MLive managing editor. He's Mark Cudmore. Mark, you're looking at the U.S. jobs market and consumer spending.
Yes, Fran, you haven't got rid of me quite yet. I am back again. I did these charts with you 30 minutes ago, but I'm going to do it better this time, I hope. This is the initial claims chart in the US, and they're really not picking up at all. People are just not losing jobs at a very rapid pace, and not nearly as rapidly as economists forecast. That's the white line here, whereas the bar is the actual number. So initial claims continue to come in below estimates. Normally, when a recession starts, these numbers are above 300K, and that's when the population is smaller. So we are far away from a jobs market that's indicating recession, and that's why consumers continue to spend. It's giving them confidence, and we saw that in retail sales this week. But let me show you the next chart. That spending is fueled by borrowing, because we do have a cost of living crisis. Inflation is squeezing household budgets. So even though they're feeling confident because they've got jobs, they have less and less money and they're borrowing more. This is credit card balances, near $1 trillion in the US. So this will all end in tears at some point. It always does in every cycle. But when does it end? It ends when the jobs market starts cooling. We're seeing no sign of that. One final point. Which sector will get hurt most? Well, it goes back into this classic issue we've got at the moment about the kind of age divide of where kind of the wealth destruction hits worst. And you see this blue line? This is the credit card borrowings, or delinquencies, I should say, from 18 to 29-year-olds, whereas the white line is all ages. And you can see that it's the 18 to 29-year-olds who are already starting to pick up delinquencies at a much faster pace. And that's even though they've got forbearance on their student debt until the third quarter this year. Just imagine, those delinquencies pick up and student debt has to be paid down again. It's going to be a very tough third quarter.
Mark, there's something that you also said earlier that really, piqued my interest, which was very, very smart way of looking at yields and actually the correlation between yields and equities. And you basically argue that it's not what yields do that is moving equities in one direction or the others, is why they do it.
Yeah, absolutely. I think it's this point that we're back into actually a pre-GFC world, a normalized world where when yields go higher because growth is good, stocks actually like that. When we get strong economic data, it's saying, hey, Fed policy isn't too restrictive for this economy. It doesn't matter if yields go higher. And so that's the environment we've had much of the last couple of weeks. Yesterday, however, yields went higher not because of strong growth data. In fact, the growth data yesterday wasn't particularly great overall. It was because we had a very high inflation print and we had hawkish comments. So when yields go higher because of high inflation or hawkish comments, stocks don't like it. When yields go higher because of a strong jobs print or strong retail sales, then stocks don't mind.
I love that analysis. Thank you so much. Our Bloomberg MLive managing editor, getting us started also for our weekend reading, Mark Cudmore. Now, two top Fed officials are opening the door to an upshift in rate hike as U.S. economic data signals the fight against inflation is far from won. The St. Louis Fed President Jim Bullard and Cleveland's Loretta Mester have both made the case for a bigger hike next month.
At this juncture, the incoming data have not changed my view that we will need to bring the Fed funds rate above 5% and hold it there for some time. Indeed, at our meeting 2 weeks ago, setting aside what financial market participants expected us to do, I saw a compelling economic case for a 50 basis point increase, which would have brought the top of the target range to 5%.
I think we can lock in this disinflationary trend by continuing to have policy rate increases during 2023, even though the real economy looks like it's going to continue to grow and the labor market broadly across the country looks like it'll remain strong.
Now, for more on the markets, we're joined by Bloomberg's Christina Aquino. Christina, I have many questions on the ECB and Isabel Schnabel and that interview she gave to Bloomberg in a second. But actually, the Fed, they're not voting members. They're two hawkish members. Why is the market kind of shifting on the back of those comments?
Well, Francine, I think despite the fact that both Mester and Bullard aren't voters this year, they are very influential voices when it comes to swaying the FOMC vote in general. And, these are two people in particular that markets really listen to. And so when they're making the case for those bigger rate hikes, I think it does still carry weight despite the fact that they're not voting. And it also speaks to kind of the mentality at the FOMC right now probably is that they are leaning more toward going higher in terms of the Fed rate peak to really address this inflation issue. Remember that we've also not heard, it's not just Bullard and Mester kind of delivering this message. We've heard from other FOMC members over the last few days, essentially saying the same. And I think it's really now they've gotten the markets to pay attention to this message, higher for longer and potentially an even higher peak.
Christy, I mean, the interview that actually our team in Frankfurt did with Isabel Schnabel is definitely moving markets. It's sending peak rates, estimates higher. And there's a quote, I don't know if we have a quote board, or actually I'll just say what Isabel Schnabel, one of the most powerful members of the ECB, has said. She says, look, markets are priced for perfection. This is Isabel Schnabel. They assume inflation is going to come down very quickly. That would be a very good outcome, but there is a risk, she says, that inflation proves to be more persistent than is currently priced in by financial markets. I mean, this is hawkish. I mean, it's as hawk as you can get almost.
Absolutely, Francine. And I think it also strengthens the message that we've heard from Christine Lagarde over the last couple of weeks when we did hear from the ECB rate decision. I mean, she did also sound very, very hawkish at that point in time. And so the fact that we have now another governing council member, an influential member of the ECB saying as much the same, I think that really is driving home the message as well. And I absolutely agree. I think markets over the last couple of weeks have been very, very keen to kind of grab a hold of that positive message of inflation is easing, maybe not so much on the rate hikes front is necessary, but I think that's really being shattered now by what we're hearing from both policymakers from the ECB and the Fed.
Yeah, and I wonder whether, I mean, we know it's not concerted, or we don't think it's concerted, but the fact that it comes from both sides maybe does, send markets certainly sitting up to listen to what exactly is going on. If you look at interest rate traders are now pricing in a terminal rate for the ECB, 3.6%. in September. What does that mean? We talk now about a no landing, which is basically the idea that we're kind of like in limbo for a little bit longer. Is that something that we need to take off the table?
Well, it certainly pours some cold water over that theory at this point in time, Francine, because I think, yeah, we're now kind of getting back into more inflationary signs from various economies. The U.S., of course, with that PPI print yesterday. And so, it's really focusing the minds of policymakers in particular that inflation is still raging on, and they're really far from kind of being able to declare that it's all conquered and the war is won, as you've said. And so I think, we're probably going to get back into this idea that markets are going to have to be reminded that these central banks are not done yet. They're going to have a lot more to do. And then again, that resurfaces the question of, so what is going to break in the process of central banks really trying to address inflation in a more focused way?
Now, we still have quite a lot of earnings. So we have NatWest coming out with better than expected figures or giving back to shareholders. Hermes in the luxury space also better than expected. Or overall, is there like a common thread to all of these earnings?
Yeah, very interesting, Francine. I mean, I think there are some signs of demand really recovering. Hermes in particular, we've seen some positive lines from them. We saw similar lines as well from the likes of Airbus yesterday, speaking to kind of this recovery in demand. I think there's still a lot of caution there in terms of future uncertainties and how that's going to shape up when it comes to just how the consumer is going to hold up, in the second half of this year. But certainly some green shoots that we're seeing here in terms of the demand story. And of course, the other theme as well is buybacks, right? I mean, this is how many companies now have we seen really emphasizing that need to give back to shareholders? I mean, it's certainly something, it's quite interesting strategy for companies to deploy at this point in time. Again, because there's a lot of uncertainty, investors probably feeling a little bit more cautious now after the rally that we've seen in January. They might be tempted to take some money off the table. And so with companies kind of coming back in, saying that they're going to give back to these shareholders, that's something that can kind of keep them in the markets at the moment, at least for now.
Christine, thank you so much. Christina Aquino there from Bloomberg. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. Bank of America is planning to cut jobs in its investment bank, one of the last major holdouts in the industry to bow to cost pressures. Bloomberg sources say the reductions could affect some 200 bankers globally. This as the investment bank industry has been hit by declines in takeovers and stock and debt offerings. Strong demand for expensive trucks is helping General Motors fund its transition to a bigger offering of electric vehicles. In an exclusive interview, CEO Mary Barra says it will be GM's big year for EVs as production ramps up.
When I look at our portfolio of internal combustion engines, I'm really excited about it, and they're doing well. The customers are responding. I mean, we still see very strong demand for our trucks, our full-size SUVs, the Chevrolet Suburban and Tahoe, the GMC Yukon, and the Escalade. Again, we can't build enough of them.
Credit card balances in the US hit a record in the final quarter of last year as robust consumer spending collided with rising prices. According to data from the New York Fed, Americans had $986 billion on their cards, which was the biggest quarterly increase in data going back to 1999. Late payment is also surpassing pre-pandemic norms, with more than 4% of credit card debt described as in serious delinquency. That's your Bloomberg Business Flash. Francine?
Thank you so much, Alice Atkins in London. Coming up, Mercedes jumps at the open as German luxury car maker plans a €4 billion buyback. We hear from the chief executive, Ola Kaljanis, next. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
News breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
Now, we're just getting some breaking news out of Mercedes earnings. You can see on the back of that, the share price actually gaining 1.85%. Now, some of the margins that we're looking at, and of course, we did speak to the chief executive, Mercedes seeing lower earnings and is actually planning a €4 billion buyback. So the picture overall for Mercedes is also saying that the EBIT for 2023 is slightly below a prior year level. We spoke to the chief executive.
I think we need to look at the macro environment and what the economy is going to do. It's natural that central banks around the world, when inflation has been rising for the last year or so, to react with interest rate hikes. And that is designed to clearly put a little bit of a cooling effect on consumption and get the inflation down. So we're watching macro, and that is why we take a slightly cautious view on what the market will do and are guiding for sales around the same level as 2022. But at the same time, our business model is very robust with a guidance of between 12 and 14% return on sales. If we execute well, 2023 can be another good year for us.
And so you cite the consumer there being squeezed a bit. Are you seeing that change in kind of the cars that people are choosing to buy? Are you seeing a change in consumer behavior due to that squeeze?
Not yet. We have been seeing on nudging up in the segments that went in, and also making sure that our top-end offering is very attractive. In fact, in 2022, our top-end vehicle sales grew by 8%, and we are looking at another slight growth on the top-end side for this. So managing your portfolio and making sure that you find the right operating point in the market, I think will be key for 2023.
And on that subject, you cut prices for the EQS over in China. How has that reacted in terms of sales? Has that worked, and what went wrong there?
What we're trying to do with products around the world is very much like other luxury companies do, is ensure that you have somehow level pricing around the world so that equivalent products have roughly the same price levels in the main markets. That's what we did with 2 models in China. Last year, our battery electrical sales grew by just shy of 70%. This year, we will be in a position to double our sales of battery electric vehicles. So the future direction going electric is set, and we're executing on it.
And China is your biggest market. Obviously, we've seen tensions rise. It's one of the things you cite as a concern in your outlook. How is Mercedes preparing in case things further deteriorate? What is your plan there?
Well, the Mercedes model, of course, is also based on the ability to export and import across the world, driven by the WTO rules. What we have learned from the COVID and the supply chain issues that we had mainly on the semiconductor side over the last couple or 3 years is that we need to create optionality on the supply chains, and working on that in our main verticals.
That was the Mercedes chief executive speaking to Bloomberg's Oliver Crook. Now, joining us now to talk markets, to talk equities, Joe Heaston from our equities team to tell us what stocks are on the move. We start with a bit of luxury, French luxury, nonetheless.
We do, very fitting, exactly, Fran. So we're starting with Hermès, the maker of £45,000 handbags. Not sure that's exactly what you need in the cost of living crisis, but they are reporting a good sales jump today, up around 23% versus analyst expectations, up 17% in terms of their last quarter. Record revenue for the full year as well, around 12 billion for that stock. We did see the CAC 40 index in France yesterday, almost at a record high, thanks to companies like Hermès and also Louis Vuitton, and Kering, the owner of Gucci, which reported earnings earlier in the week, pushing that index higher. That stock, the last time I checked, was slightly lower. I think it was down with the broader market. But as we can see, big boom for the French shares more broadly. Then I'm going to stay in France, and I'm going to go to Air France-KLM, the biggest airline in the company. This one making my job a little bit easier because the stock is moving in the same direction as the headlines. They are saying that they are coming out of the pandemic period now. They're seeing that period as being over, reporting a quarterly gain in terms of their profit, around 500 million euros, versus a loss during the same period last year. That stock up 6%, a big mover in the industrial space today for them. Then I'm going to come closer to home, moving over to NatWest. This one, a bit of a head scratcher for all of us on the desk today. Really positive headlines, massive boost to profit from the rising Bank of England interest rates, but the stock getting slammed down 9%. The negatives in the report are they are saying they're reporting a small impairment in terms of some companies and people that won't be able to pay their debts. Their costs are a little bit higher than some analysts had hoped. And Alison Rose, the CEO, warning that they are seeing some early signs of some potential consumer weakness. That's not what analysts or investors wanted to see for NatWest. As I say, that's the biggest decliner on the FTSE 100 today, down 9% for the company formerly known as Royal Bank of Scotland.
Yeah, I'm also surprised about that, Joe. We spoke to the chief executive, and actually she was quite bullish going forward, so maybe they're seeing something. We'll keep digging. Joe Easton there with our stocks to watch. Coming up, we'll have plenty more from China's top tech banker. He's missing. His bank says they have not been able to contact him in days. We'll bring you the latest on that story shortly, and this is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
than £100 in savings, and that means their financial resilience when you do get hits, as we have in the economy, are tough.
NatWest Chief Executive Officer Alison Rose speaking to us a little bit earlier. Actually, if you look at the share price, it's really sliding quite significantly. We did speak to the Chief Executive earlier on, according to a couple of banks. So they reported higher costs. They also guided for profits below what some analysts had expected. Now let's get to another of our lead stories in banking. China's top tech banker, Baofeng, is missing, leading to speculation of another clampdown by the government. Now, the investment bank he leads, China Renaissance, says they cannot reach him. The bank's shares slumped as much as 50% in Hong Kong today. So joining us now to discuss all of this is Tom Metcalf, who leads REMEA banking coverage. Tom, this is a pretty incredible story coming out of China. What do we know?
Yeah, not much more than what you've just said. Basically, we understand the banker's family has been told he's assisting an investigation with the Chinese authorities and has been out of contact effectively with the company for about 2 days. We're sort of reaching around for understanding. We've obviously seen cases like this before, and frankly, there's often an information vacuum, for weeks, sometimes even months, before sort of these people return to the public eye. So all eyes on his firm, all eyes on his, sort of his family as well, and just wondering what's going to happen next.
Tom, switching to Bank of America, what's the latest on the proposed job cuts?
Yeah, so Bank of America sort of finally sort of coming up alongside other banks like Goldman, et cetera, in actually making some cuts. So for a long time, they held off and said, no, we'll sort of reduce costs going forward in terms of cutting hiring, freezing hiring. But now there actually are going to be cutting, it looks like a few hundred bankers in investment banking.
Tom, I mean, there are quite a lot of banking stories. So I know we're looking at China, we're looking at Bank of America, and then we have NatWest. You and I were talking about it a little bit off air. I mean, they actually surprised with a bigger than expected share buyback. The market is still not liking this. The share price is down significantly. What are they worried
absolutely
about?
Hating it. So it looks like it's going to be the guidance that people are focusing on. So cost, guidance, all kind of a little bit disappointing. And that's outweighing the buyback. But the size of this move, I mean, I think they slid as much as 9.5%. That is quite surprising. It's dragging down other lenders. And I think it just goes to show investors, are not looking back. They're looking forward, and they're very concerned about what sort of 2023 is looking like.
Yeah, it's pretty incredible. NatWest sliding as much as 9%. Again, they did report higher costs and guided for profit below what some analysts had expected. Tom, thank you so much, as always, for joining us on the banking sector. Tom Metcalf there. Now, coming up, the Munich Security Conference kicks off today with the war in Ukraine expected to dominate discussions. Now, next week marks the 1 year since the Russian invasion. We catch up with our reporter, Maria Tadeo, live in Munich. The other big story that we need to mention is, of course, what's potentially going on with Brexit. So we know that Rishi Sunak is on the move. We know that he will possibly try and broker a deal, of course, on the Northern Ireland Protocol. This could come as soon as the next couple of days. He's visiting Northern Ireland today for talks as a Brexit deal could be nearer than expected. European stocks down 0.8%. This is Bloomberg.
Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Stocks drop with the dollar rallies after Fed hawks Loretta Mester and James Bullard signal support for steeper rate hikes. China's top tech banker Bao Fan goes missing, fueling speculation of a renewed government clampdown on the finance industry. Plus, the Munich Security Conference begins today against the backdrop of Russia's war in Ukraine and the response by NATO and other allies. This is what equities are doing. Quite a lot of pressure. European stocks opened lower, about 0.8% lower. They're now down 1%. Look, if you look at expectations of steeper U.S. rate hikes, that's trying to get hold of the markets. This is after these two comments from Loretta Mester and James Bullard. And then we also had the ECB, of course, for Isabel Schnabel saying that she thinks there could be a mispricing on the markets of how much they'll have to do in terms of interest rate hikes. Very hawkish message. And so that's putting extra pressure on a lot of stocks. The sectors that are on the move. Now, we had some earnings. A couple of the banks came out better than expected. NatWest, on all metrics, did better than expected, but the share price is down significantly, possibly because they're talking about costs going forward. And so, analysts and shareholders now really looking at the forward guidance. Auto parts, construction, healthcare, not losing as much as some of the other ones. Technology's down 1.8%, media also down 1.3%. Now, next week will mark 1 year since Russia's invasion of Ukraine, an action that upended global political relationships as well as financial markets and economies. Bloomberg's Guy Johnson has more on how the conflict has changed the world.
The war in Ukraine has arguably provoked the most profound change in the world order since World War II, one in which Vladimir Putin has found himself increasingly isolated.
I'm taking robust action to make sure the pain of our sanctions is targeted at the Russian economy.
The West responded with a show of unity, both with sanctions on Russia and with billions of dollars in aid for Ukraine. NATO allies have provided increasing amounts of weapons to Kyiv, including rocket launchers, air defense systems, and more recently, dozens of combat vehicles. The joint efforts have led to a renaissance for NATO. But the war has also caused an economic dilemma for the West.
Over-dependency on commodities from authoritarian regimes like Russia makes us vulnerable, and we should not repeat that mistake when it comes to China.
The war has brought Vladimir Putin and Xi Jinping closer. China has increased imports of Russian oil, but also sought support over Taiwan. Russia has also turned to Iran to defy sanctions, with a new $25 billion trade route through the Caspian Sea. Others, like India, have declined to condemn Russian aggression while benefiting from cheaper oil. Meanwhile, Turkey is playing the mediator role amid deepening economic ties with Russia.
Putin stands firm because he is dominating the political scene. There is no media freedom, there is no NGOs, there is no opposition, but people feel the effects of Russia's isolation.
As such, the future world order could well be defined by the length of the conflict, as well as Vladimir Putin's support abroad and at home.
Bloomberg's Guy Johnson, they're on the war in Ukraine 1 year on from the invasion. Now, one of the world's leading forums for geopolitical debate, the Munich Security Conference, kicks off today. The war in Ukraine is expected to dominate discussions. Now, we spoke to Ukraine's Deputy Economy Minister earlier about the economic situation there.
The economy suffered a lot because it's obvious that the challenges we're facing are not coming without consequences. So eventually, we must admit that the economy shrunk for at least 30.5, 31% in GDP. We do anticipate little growth in the margin of like 2% at the end of 2023.
For more on all of this, we're joined by Bloomberg's Maria Tadeo, who's in Munich for us. So, Maria, good morning. What are you looking out for at the Munich Security Conference?
Yes, Francine, we're back at the Munich Security Conference. Just this morning, this realization for everyone here. A year ago, Volodymyr Zelensky was here in the same hotel that you see behind me, telling the world Ukraine does not want a war, but it's ready for it. And remember, Russia, which essentially lied until the very last minute, saying there would be no invasion. Today is this realization that the European security framework is essentially gone after the invasion. You have now Ukraine fighting for almost now a year, and a big question of what happens next. There's a lot of uncertainty here, Francine, in terms of the next few weeks. We know that NATO has said already there is an offensive underway from Russia. You do not have to wait until the spring. It's going on now. And at the same time, Ukraine waiting for the weapons and the training to launch their own counteroffensive. So there is a sense here that the next few weeks, the spring, the summer, could really dictate the way that things are going to essentially pan out over the medium term. There's two big speeches coming up here, which we can now confirm. The German Chancellor Olaf Scholz will speak here. The French President, also Emmanuel Macron, will also feature in the morning. And it'll be interesting to see not just how they view the war going on, but also what happens next. What is the future security guarantees for Europe and Ukraine that they could provide?
Yeah, and beyond Ukraine, Maria, where does this leave international relations, especially in the light of course, the tensions between, the U.S. and China over this balloon spying?
Yes, and that's the other big focus point here, Francine, when you talk to officials behind the scene. It really is the United States and China. By now, it's clear these are two countries that are rivals, but the question is, can you compete with that conflict? To me, it was interesting to hear from the President of the United States yesterday, Biden, saying he's not apologetic for shooting down the balloon, but also signaling he is open to speaking with the Chinese leader and hopefully cool down tensions. Now, in this conference, there will be an American delegation led by the VP Harris, and also a Chinese delegation led by the Chinese top official Wang Yi. To me, it'll be interesting, very interesting to see whether there is some kind of back channel diplomacy. And come Monday, we get kind of a temperature check of whether tensions are indeed cooling down or not.
So, Maria, we've also just had gas in Europe fall to its lowest price in 17 months. Is this validation for Europe that Russia's energy weaponization is over?
And Francina, what a number, right? To see gas prices falling this way. Remember, in August, they're speaking to beyond 300 euros. For Europeans, what it shows, and I think you really nailed it in your question, is validation that the strategy has worked, partly because of the measures that they took, that signaling to the market, but also we should note, a lot of this is good luck. There was a winter that was not as cold as expected. In some extent, I can tell you today it's not as freezing as it usually is, and that has really helped the European narrative going on. I think the big question, however, is what happens for next winter, how you deal with the storage without Russian gas.
Thank you so much, Maria Tadeo there from the Munich Security Conference. Coming up, we'll take a closer look at the global energy market 1 year on from Russia's invasion of the Ukraine. This is Bloomberg.
we have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to The Open, everyone. 40 minutes into the European trading day, the specter of inflation leading to higher interest rates really taking hold of markets today. We had two hawkish members, influential hawkish members from the Federal Reserve yesterday. Although they're not voting, they hammered the message home. And then we also had a great exclusive interview that our Jana Rando and Alexander Weber did in Frankfurt with Isabel Schnabel. And that also not only moved expectations for where rate hikes end up in Europe, but of course are shifting the debate. She says markets may be mispricing the impact that inflation will have on further rate hikes. You can see European stocks on the back of that down 1.2%. So it's almost 1 year since the war in Ukraine started, causing turmoil in global energy markets. Now, China's reemergence from COVID-0 and renewed scrutiny of surging energy profits have also contributed to a volatile 12 months. Now, for a closer look at energy markets, we're joined by Crystal Energy Chief Executive Officer Carol Nakle. Thank you so much, Carol, for joining us. First of all, how would you describe the energy complex right now in Europe 12 months into the war?
It's interesting to see the markets today, particularly for oil and gas, because they seem to have forgotten that there is a raging war still at Europe's own doorsteps, and also the impact on global oil markets. Because if you remember, exactly a year ago, oil prices and gas prices were on a relentless upward march, even before the invasion took place. Whereas today we are at levels seen before that invasion, well before that invasion, even though the war is still going. But this tells you that despite the volatility, actually, thanks to the volatility, which is disliked by many, but because of the volatility in prices that we saw last week, markets responded, suppliers responded, consumers responded, and we are at the situation where we are today. I'm not saying that the volatility is not going to continue, but we are in a better place when we were last year around the same time.
We also saw Russia announcing it would cut 500,000 barrels a day, and actually the market's barely budging on that. Is there a belief that we're really able to move away from Russian oil, or is it simply because that was priced in?
Again, one important lesson we learned from last year's crisis is the ability of oil and gas markets to achieve redirection of trade flow. So while we turn away in Europe our back on Russian oil or Russian gas, but there was non-Russian oil and gas coming to the continent and avoiding major supply disruptions. Now, for this year, actually, many forecasts are much more pessimistic than the 500,000 barrels a day that Russia announced it would cut as of next month, as of March. Actually, I would say the most modest estimate that I saw out there is from OPEC in their own report, where they estimate a loss of 850,000 barrels a day, and the IEA estimating 1.4 million barrels a day. So 500,000 barrels a day loss of Russian oil is kind of priced in the market, and it did not really spook the market. There was an upward pressure, but it not really spook the market because of the expectations.
Carol, what's been your biggest surprise in the last 12 months? I understand that we're in a better place energetically now than we were back in January of 2022, but it was also surprising that despite all of the huge sanctions, the Russian economy is still standing. What does that tell us?
It's because of oil and gas. You know, oil and gas trade. This is one of the few sectors remaining in Russia that is really supporting the economy. And the loss of some volumes, actually, there was only a very little loss of volume, was also compensated by higher prices that we saw for both oil and even more so for gas. So that kind of supported the Russian economy. However, in the longer term, whether we like it or not, whether we accept it or not, the Russian economy is going to suffer. The impact of sanctions is most felt in the longer term. And also we shouldn't forget that Russia still has important customers buying its oil, including the second largest consumer of oil in the world, that is China, and also India. And you have Turkey, Middle East, and other countries that are still buying Russian oil and its products. So that's supporting the Russian economy as well.
One of the big questions is, of course, do a lot of these big energy companies in the West need to pay a bigger windfall tax, given the cost of living crisis and so many people have so little? Where do you think this debate will go?
This has been brewing from the moment governments, especially in the developed economies, since they opened the taps to support the economy during the lockdown period, because there was lots of spending, and usually you need revenues at some point through taxes. And who would you target first? You would target the big, greedy oil companies, and with them making record profits, this is not helping. So it was accepted, it was in the making. However, if governments are going to introduce new windfall taxes, we should be realistic that those windfall taxes are not going to capture all the profits. They will include incentives, whether we like it or not, because this is the nature of the tax. It's not only to generate revenue, but also to affect behavior. And if governments want companies to invest more in oil and gas production, those incentives have to be given.
Do you believe that this is accelerating the energy transition, or has it really, taken a backstep?
I would say there is some argument to be made on both sides. I think that, yes, there is more investment in green energy, but because of high prices, the high returns that companies have made, the high revenues that governments have generated, whether you're export or import in terms of taxes, I would say that has also given support to investment in oil and gas. And I think actually it's rebalancing this whole energy debate, because you cannot achieve climate security without achieving energy security. And energy security today needs every single source of energy that is out there. So it's too early to write off oil and gas in the energy transition.
Carol Knockley, thanks so much for joining us, the Crystal Energy Chief Executive Officer. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. UK Prime Minister Rishi Sunak is in Belfast today as expectations mount. A deal will soon be reached with the European Union on Northern Ireland trade arrangements. Sunak will meet for talks with politicians as both sides look to resolve long-standing divisions over the issue. The situation is set to be discussed with Commission President Ursula von der Leyen in Germany this weekend. President Biden says he plans to speak with President Xi Jinping over the downing of an alleged Chinese spy balloon. The US president says intelligence agencies don't have evidence that 3 other objects shot down were surveillance craft. Biden says the US wants competition with China, not a new Cold War. China's top leaders say the country has achieved a decisive victory over COVID. State television reports the Politburo Standing Committee as saying Beijing's policy U-turn late last year had been totally right. According to China's official figures, just 102 deaths were recorded on Monday. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alice Atkins, and this is Bloomberg. Francine.
Alice, thank you so much. Now, coming up, 193% gain. There's a new name near the top of Bloomberg's annual ranking of women hedge fund managers. We'll get all the details next, and this is Bloomberg.
we're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make. Welcome back to the Open, everyone. We are 51 minutes into European trading day. The picture is not rosy for stocks. Of course, a lot of the focus on inflation, whether central banks need to be much more aggressive with their rate hikes. That's the message from two key hawkish Federal Reserve members, and that is also the message from Isabel Schnabel of the ECB. Now, let's also take a look at some of the key things that markets are watching out for today. At 11:30 a.m. UK time, the ECB's François Villeroy de Gallo will comment on monetary policy and inflation in Paris. At 1:30 p.m., Richmond Fed President Thomas Barkin will speak to reporters at an event in Virginia. And then a short time later, at 1:45, Fed Governor Michelle Bowman speaks at a banking conference at the Munich Security Conference, kicking off today with the war in Ukraine taking center stage. And then I would also point out to our interview tomorrow with Rishi Sunak at the Security Conference. So don't miss a packed weekend. Saeed Hadar has joined Bloomberg's list of top-earning hedge fund managers after personally raking in $859 million in 2022. Well, he's the newest and least known name on a list otherwise dominated by industry heavyweights. Well, joining us now is Bloomberg's Charlie Wells. Charlie, great to speak to you. I mean, this is such a amazing stories. 15 highest earners in the hedge fund space brought in almost $14 billion last year. Who topped them all?
So it's hard to even conceptualize that number, but we can break it down by person. When we've got Ken Griffin of Citadel bringing in over $4 billion. Now, that is the most that anyone has brought in since we started doing this list in 2019, and it's more than double what number 2 brought in, Steve Cohen of Point72, at just about $2 billion. Now, you mentioned Hadar of Hadar Capital. He's really interesting because he's a new entrant on this list, landing at number 6, and he sort of shows how to get ahead in hedge funds, which is to make a strong conviction call, and if it goes right, you really make a lot of money. He brought in a return of 193% for investors last year, and that landed in a lot of remuneration.
So, Charlie, who lost a lot of money?
All right, so these are a lot of the long-short funds, so funds that had a lot of exposure to tech, a lot of exposure to China. These are people like Chase Coleman of Tiger Global, lost $1.7 billion. Dan Sundheim of D1 Capital lost $1.1 billion there. So we see a lot of big winners, but also people who lost a lot of money as well.
And there's, I mean, it really points to also massive shifts in the hedge fund industry. That, I mean, I know I asked, a big hedge fund manager, and he pushed back. I was like, is it being commoditized? But it's clear that money's going to these multi-strat kind of companies.
It's these multi-strategy funds that seem to be able to kind of actually hedge. I mean, the name is hedge fund, and a lot of these long shorts didn't seem like they actually were able to hedge a lot of the turbulence that we saw in the market last year. But look, we shouldn't be too hard on a lot of these long shorts. They have lost a lot of money, but when you look back to 2020, these were outperforming a lot of these other names. So fortunes can be made, but also lost very quickly in this space.
Yeah, and it kind of goes to, the fact that you can make a lot of money one year, but you can lose a lot of money the other year, so it's going to be volatile.
It goes back to that conviction issue, which in hedge funds, you do want to make a strong conviction. If you can do that, if you look at Hadar, if you look at the way that he made leveraged rates trading, that was a big risk, and there was a lot of volatility month to month, but overall, he got to that 193% return for investors.
All right, Charlie, thanks so much. Charlie Wells there with the very latest, of course, on Hedge funds. This is a picture for NatWest. Now, we had a good conversation with the chief executive. That was a short while ago. Now, shares are actually slumping after guidance for 2023 has disappointed. So NatWest shares down almost 9% after issuing a 2023 guidance that we understand disappointed some investors. It did say it would start a fresh share buyback after a surge in fourth quarter profit. Now, the bank, let's remind everyone, had weathered a rocky few months for the British economy, with provisions for bad loans actually falling from the previous period to £144 million in the fourth quarter. Now, after setting aside billions of pounds, more than they needed for potentially troubled loans during COVID-19 in general, some of the UK banks are now making smaller provisions than before the pandemic, despite economic pressures that have really left the UK on the verge of recession. So we're looking at NatWest, we're looking at Hermes. This is another company that came out with earnings. Let's have a look at Hermes, actually, if we have that stock price. Hermes sales showed it was immune to shopping disruptions in China. Sales there jumping in the fourth quarter as wealthy consumers' appetite for Birkin bags and other high-end leather goods actually remained pretty strong. I'm looking at the biggest division, which is basically leather goods and saddlery, which sells the Birkin bag. That grew by quarter during the period, also surpassing estimates. So we look at Hermes, some of the other market dynamics out there, the dollar rallying, stocks declining. This is with expectations of steeper U.S. rate hikes growing after comments by two Federal Reserve officials. That was Loretta Mester saying she had seen a compelling economic case for rolling out another 50 basis point hike. The St. Louis Fed President Jim Bullard also saying he would not rule out supporting a 0.5 percentage point increase at the March meeting. And you can see on the back of that, U.S. futures are down 0.7%. European markets also seeing quite a lot of pressure. And then we had that fantastic interview in Frankfurt made by our Jana Randau and Alexander Weber, saying that, Isabel Schnabel basically saying investors risk underestimating the persistence of inflation. So that's one of our top market stories into the next hour. This is Bloomberg.
CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Stocks drop and the dollar rallies after Fed hawks Loretta Mester and James Bullard signal support for steeper rate hikes. We also hear from Isabel Schnabel of the ECB. China's top tech banker Bao Fang goes missing, fueling speculation of renewed government clampdown on the finance industry, and NatWest shares plunge as the British bank posts higher costs and misses profit estimates, but announces bigger than expected share buyback. Now, first thing is first, let's check in on the markets. There's a lot going on. First of all, there's definitely a tilt to more hawkish messaging from central banks, not only to very hawkish but influential non-voting members of the Fed came out yesterday saying, watch out, the markets may be not pricing this correctly. But we also heard from Isabel Schnabel of the ECB, Ariana Rando, and our Alexander Weber did a great interview in Frankfurt earlier this morning, and one of the most senior officials of the ECB, Isabel Schnabel, is basically saying, look, we're still far away from claiming victory, and she specifically pointed to the fact that the markets could also be getting it wrong. European stocks on the back of all of that down 1%. If you look at U.S. futures, they're also seeing a bit of pressure, and then we look at dollar and, of course, sterling. We also know that Rishi Sunak, the Prime Minister of the UK, is in Northern Ireland trying to broker a deal, of course, on the Northern Ireland Protocol. So let's look at some of the European maps. Now, one of the big differences between a CAC 40 and, for example, a UK, of course, they both will get inflation. We're also expecting the Banque de France governor to speak a bit later today. But there's a difference in earnings story. So we have NatWest down 7% today because of forward guidance. They beat on all metrics for the last quarter, but it's really the forward guidance in terms of costs that they're worried about. Here in France, we have a luxury maker, Hermès, continuing to benefit from price points that seem to be oblivious to the cost of living crisis, and also managing to sidestep the slow reopening in China in the last couple of quarters. Now, two top Fed officials, as we were saying, opening the door to an upshift in rate hikes as U.S. economic data signals the fight against inflation is far from won. St. Louis Fed President James Bullard, Cleveland's Loretta Mester have both made the case for a bigger hike next month.
At this juncture, the incoming data have not changed my view that we will need to bring the Fed funds rate above 5% and hold it there for some time. Indeed, at our meeting 2 weeks ago, setting aside what financial market participants expected us to do, I saw a compelling economic case for a 50 basis point increase, which would have brought the top of the target range to 5%.
I think we can lock in this disinflationary trend by continuing to have policy rate increases during 2023, even though the real economy looks like it's going to continue to grow, and the labor market broadly across the country looks like it'll remain strong.
Well, one of the European Central Bank's most senior officials say investors risk underestimating the persistence of inflation and the response needed to bring it under control. Speaking to Bloomberg, ECB Executive Board member Isabel Schnabel says markets are priced for perfection. There's a risk that inflation proves to be more persistent than expected. Well, joining us now is Richard Saldana, Portfolio Manager of Global and Equity Income at Aviva Investors. Richard, thank you for joining us. When you look at the very hawkish messaging from already two hawks from the Fed, but also from Isabel Schnabel of the ECB, is the market just mispricing how aggressive these central banks have to be? And good morning.
Good morning, Francine. Yeah, I think you're right there. I mean, certainly when you look at the PPI number that we had this week, I mean, that was a real warning sign that, the fight against inflation is far from over. And obviously we've seen 10-year yields push higher of late. And I'll argue, yes, there's still some element of complacency, particularly in that expectation of sort of rate cuts that, certainly when we look at the rate curves the market has this year, it certainly feels like restrictive policy may need to be in place for a lot longer. Certainly when you look at the core elements of inflation, they're proving rather sticky at the moment. So particularly on the labor side, we're still seeing tight supply chains globally right now. So yes, I'd argue certainly elements of complacency right now.
So what does that mean for your investment strategy right now, Richard?
Yeah, look, when we think about, what we've seen year to date, look, it's been an extraordinary rally, particularly in the sort of more cyclical parts of the market. So again, you think about, some of the consumer discretionary names, industrial names, risk appetite has increased, certainly the hopes of a softer landing have increased as well. And look, whilst that's understandable, when we think about signs that inflation may have peaked, it's certainly proving rather sticky, but falling gas prices, which has helped certainly from a European perspective, China reopening as well. So certainly signs why that risk appetite should have increased. But certainly when we look at the rally and what we've seen so far this year, I think there's signs that, we may be getting a bit stretched here right now.
What's your main takeaway from earnings season? I know, a lot of companies, certainly industry groups, have done better than expected. Is there worry that this is just a delaying effect for a lot of pain to come?
Yeah, look, I'd say it's been a mixed results season. Look, companies have reported results probably not as bad as feared, but, when we look at particularly the demand side of the equation, you're certainly starting to see signs of, consumers continuing to be squeezed. Pricing has certainly remained, pretty robust, but we think that's going to come under pressure, particularly as we think, as we go through this year, if that demand environment continues to weaken further. The U.S. consumer has held up well. I mean, that's certainly been, that's certainly helped. But, we've seen that pool of excess savings, which was a big driver of that last year, continue to be drawn down. So, we look at the savings rate coming down there, signs that the consumer is starting to weaken there. So, we think that that's really, where investors need to be looking at right now, and we think, certainly when we think about it from an opportunity standpoint, we actually think the more defensive parts of the market is really where people need to be looking at right now. So healthcare, to us, remains a standout in terms of opportunity right now. So we're thinking about the health insurance sector, names such as United Health, Elevance. You think the value that these companies are offering you right now, and actually a pretty high degree of earnings visibility. So, we think about the challenges that we're facing right now. You've got companies here in that sector that are giving you that earnings visibility and actually, have derated relative to the market. So we think that's where the value is right now. It's in the more defensive parts rather than the more cyclical parts of the market.
So what does that mean? I mean, last year was all about falling valuations. Is this year, are we going to see a rally in certain parts, or how bumpy is it going to be?
I think it's going to continue to remain quite bumpy, if we're honest. As I said, when you look at, the results season we've had, it's pretty mixed. Certainly companies, I'd say, have been quite conservative in terms of their guidance. I think that reflects, they don't really have that visibility when you think of in the second half of this year. So we think those challenges still remain. I mean, as I said, pricing, has certainly helped. There's certainly been elements of the market where pricing remains strong. So you think about the consumer staples names that we've seen right now, particularly in the US, the likes of Pepsi, Coke, P&G, etc. But, we're certainly seeing in Europe, even some of those staples names that are pushing through pricing. I think of the likes of Nestle, Unilever, are seeing that element of, the consumer's not able to take some of that pricing. You're seeing that in terms of the volume weakness, some elements of trading down there. So, as I said, that pricing lever, which has certainly helped offset some of the demand weakness, we think is also going to come under pressure as we go through this year.
Richard, how do you look at the difference, for example, between Europe and the US, also given what central banks are doing? Are you tactically allocating to certain countries or regions?
Yeah, look, we think from a valuation standpoint, Europe still remains pretty attractive right now. We're certainly looking at particularly some of the companies on the luxury side of things. So, the likes of, Kering, Richemont, et cetera, LVMH. We know, again, when we think about what's going on in China right now and that sort of reopening story, that Chinese consumer coming back, that pent-up demand, I think that continues to continues to play out. And we think, this year that will continue to be the case as well. So I think that's one element. And actually, if you think about Europe as well, some of the more industrial names, particularly on the automation side of things, we actually think whilst, companies have been prioritizing, obviously from a cost base, we think automation continues to be one element where they certainly, are prioritizing spending right now. So you saw that in the results from Schneider this week, Siemens the week before. So we think, again, that automation piece is probably one area that will continue to hold up quite well and be quite resilient.
Richard, thank you so much, as ever, for all of your insights. Richard Saldana, their portfolio manager of global equity income at Aviva Investors. Now, coming up, China's top tech banker has gone missing, brewing concerns over a fresh clampdown by the Chinese government. We have all of the details next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, probably I try and play that role.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
What we're trying to do with products around the world is very much like other luxury companies do, is ensure that you have somehow level pricing around the world so that equivalent products have roughly the same price levels in the main markets. That's what we did with 2 models in China. Last year, our battery electrical sales grew by just shy of 70%. This year, we will be in a position to double our sales of electric vehicles. So the future direction going electric is set, and we're executing on it.
That was the Chief Executive Officer of Mercedes, Ola Kalinas, speaking to Bloomberg a bit earlier. Now, Mercedes, I don't know why I'm mispronouncing, is trading higher on the back of these results. Now, NatWest shares sliding this morning after it said costs would be actually higher this year. It also gave guidance that disappointed some investors. The bank did announce a fresh share buyback and a more than doubling of operating profit before tax. Now, the Chief Executive Officer, Alison Rose, says the British economy is still having a tough time.
People are facing real challenges with the squeeze of the cost of living, with higher interest rates, with higher inflation. In the UK, 1 in 4 people have less than £100 in savings, and that means their financial resilience when you do get hits, as we have in the economy, are tough.
Meanwhile, China's top tech banker, Bao Fang, is missing, leading to speculation of another clampdown by the government. The investment bank he leads, China Renaissance, says they can't reach him. Now, the bank's shares slumped as much as 50% in Hong Kong today. Joining us to discuss all of this is Tom Metcalf, who leads REMEA banking coverage. So, Tom, good morning again. What do we know about this banker in China?
Yeah, not much more than you've just said. So the company's come out and said they haven't been able to get in contact with him for a couple of days. And we understand his family's been told he's helping or involved in an investigation by authorities. So to be honest, it's again this sort of information vacuum that comes around when these things like this happen in China. And if you look at that share price, that 50% fall, it's gained back a bit more, so that's down about 28-30%. But it just goes to show these big, very difficult to sort of couch for risks that still remain.
So switching to Bank of America, what's the latest on the proposed job cuts?
Yeah, Bank of America kind of joining or getting in line with other banks who have already cut jobs in investment banking. So for a long time, Bank of America was saying, look, we're going to slow down hiring, we're going to freeze hiring, we don't need to make cuts. Now they're making a sort of limited number of cuts. We think about 200 perhaps across all of investment banking globally. And I think it just goes to show, hey, 2023, it's going to be a tough year if you're an investment banker, deal maker. 2022 wasn't great, and it doesn't look like that pipeline of deals is going to free up anytime soon.
What were your key takeaways from NatWest earnings, Tom?
Well, I nearly had a heart attack when the shares went down because I was reading them thinking, no, these are okay set of earnings. But no, market really took against that guidance from the bank. Basically, not that it was particularly bad, it was just I think the market wanted more. So they said net interest margin is going to stay roughly the same at 3.2%. And the shares, have been on an upward swing this year. And I think the market's going to be taking quite a lot of that back today.
Tom, thank you so much. Tom Metcalf there with the very latest on a number of banking stories. Coming up, the UK Prime Minister heads to Northern Ireland for talks as Brexit negotiations near a deal in Brussels. So we'll have plenty more on that story next. And this is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? Mm-hmm. So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah.
And so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans.
Hi, Francine.
Joe Biden says he plans to speak with President Xi Jinping over the downing of an alleged Chinese spy balloon. The U.S. president says intelligence agencies don't have evidence that 3 other objects shot down were surveillance craft. Biden says the U.S. wants competition with China, not a new Cold War. Now, China's top leaders say the country has achieved a decisive victory over COVID. State television reports a Politburo Standing Committee is saying Beijing's policy U-turn late last year has been totally right. According to China's official figures, just 102 deaths were recorded on Monday. Credit card balances in the U.S. hit a record in the final quarter of last year as robust consumer spending collided with rising prices. According to data from the New York Fed, Americans had $986 billion on their cards, which was the biggest quarterly increase in data going back to 1999. Late payments is also surpassing pre-pandemic norms, with more than 4% of credit card debt described as in serious delinquency. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, the UK Prime Minister Rishi Sunak is in Belfast for talks with Northern Ireland parties today. It comes as expectations mount that the UK and the EU are actually close to reaching a deal on post-Brexit trading arrangements. Now, for more on all of this, we're joined by Bloomberg's Joe Mays. Joe, we think we're nearing a Brexit deal. How soon could it come?
Well, it sounds like it could come perhaps Tuesday next week. That's the expectation. Rishi Sunak will have these meetings in Northern Ireland. He'll have these meetings potentially with Ursula von der Leyen in Munich on Saturday, which will be the high-level political talks, which could get us over the line. And then the expectation is that Rishi Sunak could go to his cabinet on Tuesday to brief them and then present a paper in Parliament with the deal. So, yeah, it sounds like we could be very much at the end game. It's Brexit all over again.
There you go. As far as we understand, Joe, so Rishi Sunak's Belfast trip is to begin an engagement process. Is he going to promise things? Do you know what they'll discuss in detail?
We don't know the full details, but I imagine he'll be looking to reassure the parties in Northern Ireland that the negotiation that he's done with the EU has achieved what they want to see. You recognise the likes of the Democratic Unionist Party. They've been boycotting the executive in Northern Ireland over the situation with the protocol. So Rishi Sunak will be looking to convince them that, yes, this deal does perhaps reduce some of the trade frictions that the DUP are very concerned about. It perhaps rolls back some of the influence of the EU over Northern Ireland, but that's really to be seen. It will really go down to the details, especially over things like the role of the European Court of Justice. So yeah, lots to look at in those details, which could be make or break whether this achieves what Sunak wants to do.
So, Joe, I mean, the other thing is that Tory Brexiteers have definitely indicated that they would oppose any agreement that would allow the European Court of Justice to maintain jurisdiction on matters of EU law in Northern Ireland. Are we, if you look at all the constituents and all the stakeholders in this, who's going to likely block this more?
Well, I think the key thing that goes in Rishi Sunak's favour is that those hardliners, so to speak, those purists on the Brexit question within the Conservative Party, their number is fairly few at this point, such that Rishi Sunak probably could afford to have a decent amount of dissent from that group. He'd still be able to get any kind of deal past Parliament because he has enough of his own kind of backers in the Conservative Party, plus even Labour might be supportive as well. So I think Rishi's bet here is that, the hard right might not like it, but doesn't matter. He thinks he'll still be able to get this through.
And will that help with the economy? Joe, can you give us a sense of exactly, where the agreement will fall on?
Well, if it does reduce some of the trade barriers between Northern Ireland and the rest of the UK, that might perhaps give a boost to trade to Northern Ireland. But Northern Ireland has been one of the more successful performing regions of the UK in recent times, perhaps because of that location it has, both in the EU single market and in the UK's internal market. So that will be some benefit. And also this would probably reduce significantly the prospect of a trade war with the European Union, which had been a kind of slightly distant prospect, but a prospect nevertheless, because of these ongoing rumbling tensions over the Northern Protocol. So that'll be an upside as well.
Joe, thank you so much. Bloomberg's Joe Mays there on the very latest on this Brexit negotiation. Now, Bloomberg's Maria today will also be speaking with the UK Prime Minister Rishi Sunak in a panel at the Munich Security Conference. That panel takes place tomorrow on Saturday, 12 p.m. UK. That's 1 p.m. Central European time. And we'll have, of course, all of the highlights on Monday. We'll also be covering all things UK every week on Thursdays, and that's at 9:30 a.m. in our half-an-hour special. The markets, if we focus on the markets, so far the dollar has been rallying. Stocks have also been dropping along U.S. equity futures, with expectations of steeper U.S. rate hikes growing after comments by two Federal Reserve officials. Now, if you look at the Bloomberg dollar gauge, rising some 0.5%, it has erased its losses for the year. Yields on 2-year and 10-year treasuries both set 2023 highs this week. Now, data on Thursday, yesterday in the U.S., really showed U.S. producer prices rebounded in January by the most since June. We did have two Federal Reserve officials talking about some of these steeper U.S. rate hikes. The Federal Reserve Bank of Cleveland President Loretta Mester said she'd seen a compelling economic case for rolling out another 50 basis point hike. St. Louis Fed President James Bullard also said he would not rule out supporting a 0.5 percentage point increase at the March meeting. The other story we need to watch out for is Isabel Schnabel. Now, she spoke exclusively to our Alexander Weber and Jana Rando in Frankfurt. She is one of the most senior officials, of course, at the ECB, and she basically says that investors risk undermining the persistence of inflation and the response needed to bring it under control. I don't know if we have a full screen of what exactly Isabel Schnabel has said, but she says, look, we're still far away from victory, and actually the markets could be getting it wrong. So we'll have a full look of that, the hawkish messaging from the ECB and from the Fed. Let's also take a look at some of the key things that markets are watching out for today. 11:30 a.m., it's the ECB's François Villeroy de Gallo. He will comment on monetary policy and inflation in Paris. 1:30 p.m., Richmond Fed President Thomas Barkin will speak to reporters at an event in Virginia. And then a short time later, we hear from Fed Governor Michelle Baumann. And then it's the Munich Security Conference where our Maria today is attending. Coming up, we're joined by the Infosys President Mohit Joshi. We'll discuss the skills market, the risk of recession, and much more. That interview coming up next, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
News breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
This is Bloomberg.
Here are your top stories. The stocks drop, the dollar rallies after Fed hawks Loretta Mester and James Bullard signal support for steeper rate hikes. China's top tech banker Bao Fan goes missing, fueling speculation of a renewed government clampdown on the finance industry. And NatWest shares plunge as the British lender posts higher costs and misses profit estimates, but announces a bigger than expected share buyback. Well, good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to an interview with the president of one of India's biggest tech companies. Infosys shrugged off fears of a global economic downturn in its earnings last month, remaining bullish on its sales forecast. Well, that comes amid mass layoffs in the tech sector. I'm delighted now to be joined by Infosys President Mohit Joshi. Thank you for joining us. I know you want to talk about reskilling. I know you want to talk about the war on talent. But first of all, is it easier for you now to find the right talent to hire?
Thank you, Francine. So first of all, I think, look, there has been an improvement as far as the talent situation is concerned. And we have seen levels of attrition, go down in the industry as a whole. The industry as a whole is still growing. It's still absorbing an incredible amount of talent. And just historically, right, if you look at our business, for instance, 350,000 employees, we hire probably 100,000 plus people every year. So just historically, we have built that infrastructure to train people, to reskill people. And that's really helpful at a time like this.
But developers and engineers were extremely expensive, especially in the middle of COVID-19.
Yes.
Is that getting easier? Are they getting cheaper?
I think so. I think I wouldn't say that they're getting cheaper. Okay. But if you think about it, right, our levels of attrition had probably peaked about maybe 15 or 16 months ago. And we have seen a steady decline, including in the most recent quarter. And we think that this decline will continue. So the reduction in the attrition rates, I think, is a very strong positive that we are seeing.
How much time are you focusing on actually reskilling? I know this is one of your biggest passions. One of the things actually that certainly this economy probably needs the most.
Yes.
There's always a problem with timeline, is that we need workers, skilled workers now.
Yeah.
Reskilling takes time.
I agree. But look, I think this is something that you need to do programmatically, right? And this is something which is really built into the DNA of the company, of Infosys. And so just historically, earlier we used to build these gigantic campuses, including the largest corporate university in the world and a very large 3,500 people campus in the US. So historically, you send people to corporate universities to train them. And then now, obviously, you supplement that with very powerful digital platforms. And the uptake is really powerful, right? I think the thing is that we often underestimate how motivated employees are to learn. So if you look at our learning platform, for instance, we see about 15 to 20,000 people log in every single minute of the day, learning for about 45 to 50 minutes a day. We look at about 1,000 people a day taking proctored assessments to gain certification. So the employees themselves are very motivated. And as far as we're concerned, look, we have a visibility into the business for the next 4 or 5 years. So building out that roadmap of what skills you're likely to need, and then making sure that you're able to match the training program to that.
But you're a private company. Why are governments not doing this more? Is it a matter of spending, or does it need to be private-public partnerships?
I think that governments are now getting into the motion as well, right? And I'll give you a couple of examples. In the UK, for instance, we've tried up with the Brent Council. Now, the Brent Council, as you know, is in London, right? And we've opened up our digital learning platform to everybody who lives in the Brent Council. There are about 50,000 people now who are actually learning. And once they've learned, they've been certified, there's the opportunity for them to get jobs with us or with other people.
Yeah. And that's something that will lead to meaningful changes in terms of reskilling.
I think so. Look, I think 50,000 people in a council is a pretty reasonable number. And we've got at least 3 or 4 other councils that are looking to follow suit. We're also working with the council so that we can help the small businesses become more digital ready and more digital savvy. So look, whenever we speak to governments across the world, right, whether it's in Europe or in Asia or in Latin America, governments are very keen to build those tech skills and to get those tech jobs on the one hand, there is a shortage of digital labor across the world, and on the other hand, these are really well-paying jobs.
Mohit, talk to me a little bit about what you're seeing in the world economy. So the world is bracing for a recession. I mean, it kind of depends on the day or sometimes on the hour, given the volatility that we're seeing in markets. What are you hearing from clients? Are they spending less on tech or more?
Sure, Francine. So look, I think you covered it when you kicked us off, saying that when we'd announced our results for the third quarter in the first week of January, we'd given like I would say, a reasonably positive assessment about how we see the market. Clearly, there are weaknesses in some sub-segments, for instance, in mortgage origination or some parts of the retail business. But on the whole, the spending for tech remained really resilient. And I think people also are consolidating in favor of the larger and stronger companies like us. We also spoke briefly about Davos, and we were both there just a couple of weeks ago. And I would say that the mood has certainly improved, right? The mood has certainly improved. I think the strength of the U.S. customer, the U.S. consumer, is really holding up the U.S. economy. I think the European situation is better than we had feared in October. There's a lot of optimism that growth in China will again reboot the world economy. So it is, the world does seem to be in a more positive place than just 4 months ago.
Is it too optimistic? When you look at the world, I mean, what surprises me, and I try and cover this, day in, day out, is that actually we've gone from interest rates. The rise in interest rates have been so quick that I don't know whether there's a delay effect of something ugly coming up.
I agree. Look, that is always a fear. There's always the fear that we have underestimated the damage that high rates can do to the economy. But I'd much rather have, too much optimism than what we had in May of last year, right? Like in May of last year, when you were in Davos, it was borderline suicidal, right, the mood. And so I think we went into the start of the year with very low expectations and maybe thinking that there's a shoe to drop in January or February, very large pullbacks. And the fact that that hasn't happened, the fact that the consumer has stayed strong. I was in a number of sessions with the banks, right? And banks are constantly looking at their data in terms of spending, in terms of, incomes. And what they're saying consistently is that the consumer is very strong. And I think that's helped power the economies.
Yeah, we had a bit of and that's what NatWest said today, but actually the share price is down 8%. So that's maybe another story. Can you give us a glimpse into, when you look at your clients, who's doing well and who's not in terms of industry? Because that always, you're such a great barometer to make us understand who's spending in this kind of world economy.
So look, I think, if you look at the financial services business, right, the large global banks and the large American banks are still doing well, and a number of them, including Bank of America, for instance, have stated their optimism and their desire to keep investing from a technology perspective. If you look at the utilities and the energy companies, they have done really well, through this cycle. Some of the digital natives among the retailers are doing really well. But on the whole, I would say that the U.S. economy has been a gigantic source of strength. In some other industries also, even if they're not doing really well, if you look at the auto industry, for instance, the move to electric vehicles, the move to digitization is such a powerful force pushing technology spend that it has had a very positive impact on our business.
How are you thinking about possible M&A? Are there targets out there because valuations are quite cheap?
Well, I think, look, we've never been hugely acquisitive as a company, but over the past 4 years, we've made 10 acquisitions. We've also entered into 3 joint ventures. We did one actually in Europe quite recently, Base Life Sciences, which is a company very focused on digital technologies in the healthcare space. So we're going to continue looking at, possible targets. We have a really strong balance sheet, a lot of cash and no debt. So that makes us, gives us the ability to really pounce if something is attractive.
And are things attractive at the moment? Again, just in terms of valuations, whether you want to buy them or not. Does everything feel a bit depressed?
I don't think that pricing in this industry has really dropped as much. And while, I think some of the price earnings ratios have compressed a bit, I don't think that you've seen the sort of drops that you've seen in SaaS software, for instance. I think services companies, the pricing and the valuations have been more resilient.
All right, thank you so much for coming on today. I hope we make this a regular slot, actually, to talk about technology and Infosys. That was the Infosys president, Mohit Joshi. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bank of America is planning to cut jobs in its investment bank, one of the last major holdouts in the industry to bow to cost pressures. Bloomberg sources say the reductions could affect some 200 bankers globally. This as the investment bank industry has been hit by declines in takeovers and stock and also also debt offerings. Now, strong demand for expensive trucks is helping General Motors fund its transition to a bigger offering of electric vehicles. In an exclusive interview, CEO Mary Barra says it will give GM's big year for EVs as production does ramp up.
When I look at our portfolio of internal combustion engines, I'm really excited about it, and they're doing well. The customers are responding. I mean, you know, we still see very strong demand for our trucks, our full-size SUVs, the Chevrolet Suburban and Tahoe, the GMC Yukon, and the Escalade. Again, we can't build enough of them.
And China Renaissance shares plunged as much as 50% in Hong Kong trading today after the disappearance of high-profile banker Bao Fan. The company says it lost touch with its co-founder, one of the country's most prolific deal makers. The report is fueling speculation of a renewed clampdown on China's finance industry. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, today's Big Take looks at the hedge funds winners and losers of 2022. The 15 highest earners in the hedge fund space have brought in almost $14 billion last year. Now, here with me to discuss all of this is Bloomberg's Charlie Wells. Charlie, first of all, it's a fantastic Big Take. Who are the winners and losers?
Well, when you look at it, it really is the multi-strategy and macro managers who had an incredibly lucrative 2022. So people like Ken Griffin, who topped the list at Citadel, he brought home over $4 billion last year. Steve Cohen at 0.72, he brought just about $2 billion. But still, when you look at Ken Griffin's pay package, that is double the #2 person, and that is the most that we have seen on this list since 2019 when we started compiling this data. Interesting, there's been a new entrant at #6. It is Saeed Haidar of Haidar Capital, and he made a really interesting conviction call last year on inflation. He didn't think that there would be a pivot as soon as many others did. He brought in a return to investors of 193%, which brought him to #6 on this list. Now, some of the losers were some of those long-short funds, the Chase Colemans of Tiger Global, who lost $1.7 billion, the Dan Sundimes of Sundime Capital.
Yeah, and so it really does like hammer home the fact that, you know, strategy is everything.
It really speaks to the fact that at least right now we're seeing this multi-strategy, this macro focus really become, or was lucrative last year. But looking at Haidar Capital, you know, their January wasn't very good. And this speaks to the fact as well that these strategies shift and that money can be made quickly. When you think about Chase Coleman, you know, he was at the top of this list just a few years ago, bringing home $3 billion. Of course, last year, losing $1.7 billion.
Charlie, thank you so much for all of the insight. Charlie Wells there on our Big Take on hedge funds. Coming up, the Munich Security Conference kicks off today with the war in Ukraine, of course, expected to dominate discussions. We'll bring you the details. This is Bloomberg.
Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Next week will mark 1 year of Russia's invasion of Ukraine, an action that upended global political relationships as well as financial markets and economies. Guy Johnson has more on how the conflict has changed the world.
The war in Ukraine has arguably provoked the most profound change in the world order since World War II, one in which Vladimir Putin has found himself increasingly isolated.
I'm taking robust action to make sure the pain of our sanctions is targeted at Russian economy.
The West responded with a show of unity, both with sanctions on Russia and with billions of dollars in aid for Ukraine. NATO allies have provided increasing amounts of weapons to Kyiv, including rocket launchers, air defense systems, and more recently, dozens of combat vehicles. The joint efforts have led to a renaissance for NATO. But the war has also caused an economic dilemma for the West.
Over-dependency on commodities from authoritarian regimes like Russia makes us vulnerable, and we should not repeat that mistake when it comes to China.
The war has brought Vladimir Putin and Xi Jinping closer. China has increased imports of Russian oil, but also sought support over Taiwan. Russia has also turned to Iran to defy sanctions, with a new $25 billion trade route through the Caspian Sea. Others, like India, have declined to condemn Russian aggression while benefiting from cheaper oil. Meanwhile, Turkey is playing the mediator role amid deepening economic ties with Russia.
Putin stands firm because he is dominating the political scene. There is no media freedom, there is no NGOs, there is no opposition, but people feel the effects of Russia's isolation.
As such, the future world order could well be defined by the length of the conflict, as well as Vladimir Putin's support abroad and at home.
Bloomberg's Guy Johnson there on the impact of the Ukraine war on the world order. Now, one of the world's leading forums for geopolitical debate, the Munich Security Conference, also kicks off today. The war in Ukraine is expected to dominate discussions. Now, for more, we're joined by Bloomberg's Maria Tadeo in Munich. Maria, what are you looking at the Munich Security Conference?
Yes, Francine, and here we are back at the Munich Security Conference. And by the way, we just saw the head of the Commission, Ursula von der Leyen, walk here into the hotel. I'm sure she's going to be pleased by the moves that we've seen on the gas market today, dropping below 50 euros megawatt hour. This is essentially what the Commission would say is to some extent mission accomplished. But going to the core of discussions today, it really is about Ukraine. Remember, a year ago, almost exactly by the same date, Volodymyr Zelensky was here telling the world, we do not want a war, but we're ready for it. And Russia essentially lied until the last moment, saying there would be no invasion. Now we have a full-scale war going into its first year. We are going to hear from the German Chancellor Olaf Scholz. We're also going to hear from Emmanuel Macron. A lot of questions around what happens in the next few weeks. The offensive from Russia already seems to be underway, but also the idea of the future framework for security in Europe. It is clear now that the recipe that existed before, a friendly relationship with Russia, is no longer the case. So the comments from the German Chancellor on that front will be particularly interesting.
So, Maria, beyond Ukraine, where does this leave international relations, especially in the light of these tensions between the U.S. and China over the balloon?
Yes, the balloon, the flying object, I think it's difficult at this point to describe it. But look, the good thing about a conference like this for diplomats is that there is back channel diplomacy that happens behind the scenes. You know this very well. You've covered them for many years. And Francine, there will be a delegation from the United States led by the VP Harris. There will be a delegation also from the Chinese led by their top diplomat Wang Yi. He will also speak in a forum here tomorrow. There's a lot of comments that he may make, not just on the United States, but but also the war in Ukraine. Remember, there is disappointment that China has not played the mediator role that some would hope Xi Jinping would do with the Russian president. So I think come Monday, it'll be interesting to see whether the conference actually served to cool down tensions between the U.S. and China. Yesterday, President Biden, by the way, already indicated that he wants to have a call with the Chinese leader after the balloon saga.
Maria, thank you so much. Maria Tadeo there with a really packed weekend. She will be speaking with the UK Prime Minister Rishi Sunak at a panel tomorrow at the Munich Security Conference. I really can't wait to see what the Prime Minister says. With Maria, the panel takes place Saturday, 12 p.m. UK time, 1 p.m. Central European time, and we'll, of course, have all of the highlights on Monday. Coming up, a consortium led by Qatari royals is said to be planning a multi-billion-pound takeover of Manchester United Football Club. We'll have more details on the proposed bid next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Let's talk football. Sources have told Bloomberg that Qatari investors are preparing a roughly £5 billion opening bid for Manchester United Football Club. Well, joining us now is Bloomberg Opinion's Matthew Brooker, who looks at, of course, not only Qatar, but football. And his latest piece says, look, a Qatari bid for Man U, Manchester United would be a mismatch. So, Matthew, thank you so much for joining us. First of all, what do we know about what this bid looks like? We know that Jim Ratcliffe was interested. The Qataris potentially have more money. Do we have any idea of pricing?
We don't at this stage. I think the Glazers said they wanted at least 5 or 6 billion. Manchester United is listed in New York, and last time I looked was worth around about 4 billion. So you're looking at about 50% markup on what the market currently assesses the club to be worth.
And so, and there's a number. I mean, there's so much money swirling around, frankly, in UK football since Chelsea got taken over by Todd Bowley. Does it change the way that this is perceived? We also spoke with the Qatar Investment Authority in Davos, and they were quite clear. Look, there's opportunity in football.
Yeah, I mean, I think it really exacerbates the issues that football is grappling with at the moment. I mean, a very expensive takeover of Man United by a deep-pocketed investor like this Qatari vehicle would doubtless be good for Manchester United's prospects as a business and for on-field success if it gets a lot of investment and it ups its transfer spending. But at the same time, that's going to exacerbate this problem of the real concentration of economic power at the top of the game. And how that's affecting the rest of English football and indeed the rest of European football.
So, Matthew, do we have any idea of the intention of the Qataris? They already own PSG. It's unclear whether it's the same group of billionaires or another.
Well, they would have to argue that it's that they are separate.
Yeah.
The Qatari Investment Authority, which is the Qatari Sovereign Wealth Fund, already owns Paris Saint-Germain in France. And UEFA rules would prohibit if the same investor was deemed to own both PSG and Manchester United, then they wouldn't be able to compete in the same European competitions together. So it would be essential for the Qatari consortium to be recognised as being separate from the Qatari fund that owns PSG. And it's unclear at the moment whether they would. But
Matthew, is it because they're fans or because they really hope to make money out of it? Is the Super League going to be back?
I mean, the financial structure of football is very interesting. I mean, when you look at the finances for Manchester United, I mean, for me, it's very difficult to see how this turns into an economic return unless the economic structure of the game changes, which may be what they're looking for.
Thank you so much for joining us today. Bloomberg Opinion's Matthew Brooker. Now, the dollar is rallying. Stocks are dropping along U.S. equity futures. There are expectations of steeper U.S. rate hikes growing after comments by two Federal Reserve officials. We also had an interview with Isabel Schnabel of the ECB, one of the most senior officials there, saying that investors risk underestimating the persistence of inflation and underestimate the response needed to bring it under control. So Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller in New York, Anna Edwards in London, and this is Bloomberg.
Somebody says, I want to be, a person has an impact on society, what would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. I've been fortunate that over the course of my career, I've come up with things that have mattered to me, and I've pursued them. The best advice I ever got was from Mike Bloomberg. And he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risk. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not curing it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk, but I feel like I've done a lot.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
There's a whole range of possibilities that are out there with very different implications.
It comes down to inflation. Do we get back to this disinflationary trend, or do we see a plateau?
I don't think the disinflationary story is over, but we have to be aware that it's going to take time.
It's just much harder to get a good read on the market, right? These moves are amplified, so you can't see that.
We're still going for quality. And that's because we're in an environment where, again, the economy we don't think is going into recession, but there will be some deceleration.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It is 5 a.m. in New York, 10 a.m. in London, 6 p.m. in Hong Kong. Welcome to Bloomberg Surveillance, Early Edition. I'm Matt Miller in New York with Jennifer Zabasaja stepping in for Anna Edwards in London. Our top stories today: hawks at the Federal Reserve make the case for bigger interest rate hikes. They say the central bank should be prepared to move higher and hold for longer. $1 trillion and delinquency rates are rising as well. And shares of Mercedes-Benz are rising after the German automaker announces its first buyback in 15 years. We'll hear from the CEO, Ola Källenius. First off, let's get a quick check at what's going on in the markets after the drops that we saw yesterday. The S&P fell down to 4,090, so that is still above the year-end consensus. 24 strategies that we surveyed expect 40.75 at the year-end, and that's what we're seeing right now on futures, down to just about 0.5%. Remember, I said year-end, right? It's only almost the end of February, so we still have a long way to go before there. We saw a big jump in the 10-year yield as investors sell those bonds off on the Fed speak. You can see right now we're up another 3.5 basis points, but almost back to 390. So we're at the highest level that we've seen all year long on the 10-year yield, on the 2-year yield as well. Right now, the 10-year 389.41 going out 5 significant digits. The Bloomberg Dollar Index also putting up a big jump, and the dollar index erasing completely all of its losses for 2023. So 1249 is where we are sitting right now. That's still about 100 points off of the all-time high that we hit in 2022. But again, erasing losses for this year so far. And Bitcoin taking a big dive down. At one point, it was down 6%, its biggest drop since November of last year. Also on concern that Fed officials are coming out more and more. So far, it's been 2 non-voting members, right? Mester and Bullard, we're going to talk about that, saying that rates maybe need to move higher than had been previously anticipated and stay there for longer. Take a look at what's going on in Europe. The stock 600 is down about 0.2% right now. Although, on a positive note, we see natural gas futures contracts falling to the lowest level that we've seen in 17 or 18 months right now. So below $50 for European natural gas futures as this story has really turned around, right? We saw Europe spend over $1 trillion on excess energy costs since the beginning of the Russian war in Ukraine. Brent crude is coming down, and so are oils across the complex. 83.54 is what we see for the global benchmark. In terms of what we see here in New York, West Texas Intermediate is trading for about 77 and change. And then Mercedes, also a positive story, up more than 3%, even though the CEO said they may have profit that's lower than last year. Still, they're buying back $4 billion worth of shares, and that trumps a weak outlook. Let's get over to Jennifer Zabasajja now. She's got more on two of the biggest central banks in the world making hawkish statements. Jen?
Yeah, Matt, that's right. I mean, two of the Fed's most hawkish policymakers are signaling they may favor returning to bigger interest rate hikes to fight inflation. We heard from Cleveland Fed President Loretta Mester, who said that she saw a compelling case for a 50 basis point hike at the most recent Fed meeting. And that view is also echoed by St. Louis Fed President James Bullard. Take a listen.
I think we can lock in this disinflationary trend by continuing to have policy rate increases during 2023, even though the real economy looks like it's going to continue to grow and the labor market broadly across the country looks like it remains strong.
Now let's bring in Bloomberg Markets reporter Valerie Teitel, who is joining us here in studio. So Valerie, hawks are now saying that they're open to a 50 basis point rate increase. Are we just back to worrying again about the pace of increases? Give us your assessment.
Yeah, look, that door being open to a 50-point rate rise, even though they were hawks and yes, they are non-voters, still the fact they've come out and said it is quite jarring, and the markets are following suit. I want to go over a few of the things they said. Mester and Bullard both throwing their weight back into a possible 50 basis point rate rise in the March meeting, but they also claimed that they advocated for a 50 basis point rise in their Jan meeting. Now, we didn't know about this because they're non-voters. It didn't necessarily show up in a dissent, but it's notable because in January, we had a string of weak data. Going into that meeting, they were still pushing for a 50. Makes me think they're going to be out there even hotter claiming for a 50 in that March meeting. And again, because Brainerd is leaving the Fed, it might leave a seat open for a voter, and it's known that Mester could possibly be a voter in the March meeting if Goolsby's seat at the Chicago Fed isn't replaced in time. That's a lot to take in, yes. But we also hear from Fed's Barkin and Fed's Bowman later today. Could they add fuel to this fire? But I want to take a look at what two-year yields have done. They are now 10 basis points away from 15-year highs. Just looking at this chart gives me some heart palpitations. We're now sitting at 469. The high in November was 479. So keep that number in mind. I'm honestly shocked we haven't traded through this given that 50 basis point chat yesterday. But look, we got more hawkish Fed speak to come. And this looking ahead to next week, we also get the preliminary PMI data for the U.S. And then we get the final core PCE print. That's the Fed favors measure of inflation on Friday.
Speaking of heart palpitations, Valerie, yesterday I spoke with Mary Barra. She said that consumers on the lower end, they're starting to see delinquencies rise there. Plus, then I saw a story, credit card balances in the U.S. reaching nearly $1 trillion. That's according to a report from the New York Fed. Those delinquencies are rising as well. To me, this is like, the Jaws music for the coming recession.
Yeah, so this is coming from a quarterly debt report from the New York Fed. The credit card balances are reaching nearly $1 trillion, Matt.
Yeah, very concerning, I would say. I'm not sure about the level, right? But if delinquencies are rising, and right now we're talking about 4%, which gets to higher levels than we saw back in 2019 and 2018. So that is a concern. Valerie Teitel there walking us through what's going on with the central banks and the U.S. consumer. Meanwhile, over in Germany, shares of Mercedes-Benz are higher. A share buyback and strong fourth quarter performance helping out the luxury car maker, though it said earnings may slip this year. The $4.2 billion buyback is its first in 15 years. Bloomberg's Oliver Crook spoke to the CEO of Mercedes, Ola Källenius.
I think we need to look at the macro environment and what the economy is going to do. It's natural that central banks around the world, when inflation has been rising for the last year or so, to react with interest rate hikes. And that is designed to clearly put a little bit of a cooling effect on consumption and get the inflation down. So we're watching macro, and that is why we take a slightly cautious view on what the market will do and are guiding for sales around the same level as 2022.
Oliver Crook joins us now from the Hauptstadt. Oliver, strong full-year numbers, but some concern going into this year.
That's right, Matt, and it all ties into what you're talking about this morning, locking in that disinflation in the macro environment. So they've cited exceptional uncertainty going into 2023. They said that their revenue is going to be dead flat. Sales will fall a little bit. It's down to partially geopolitics, but also down to this idea that, you know, the rates are really starting to squeeze consumers, and that he said that you're not seeing it yet in terms of the models that they're choosing, but they're bracing for that. But I think that it's worth actually just spending 1 second looking back at 2022. It really validates this this tack that Mercedes has taken to go towards the luxury. If you go to the DAX low point for the pandemic, 2020, March 18th, Mercedes is the best performing stocks on the DAX. It's up more than 300%. And if you look at the market cap level, it's overtaken VW. So, you know, a gratifying year, getting some more help this morning with the share buyback.
So then, Oliver, I mean, looking ahead, if they are taking this cautious outlook, what then are they optimistic about? What is it that's actually going to drive growth for Mercedes past its competitors?
So regionally, it's going to be the United States. So you have still strength coming in the United States. There is also a hope of a rebound in China after, you know, in the latter part of the year. But the category is going to be EVs. So, you know, Mercedes had a 70% jump in their EV sales. It's not a huge amount of the proportion of what they sell, but they want to double that. And then there's also the Inflation Reduction Act. I asked the CEO about that. Have a listen to where that fits in.
We try to set up our production structures to, as best possible, meet the demand in the different markets. And the fact that the Inflation Reduction Act pushes the electric agenda, which goes hand in hand with our strategy, will make it economically more attractive to invest in the United States. But I also would like to caution that governments around the world should not couple that with protectionistic elements of such policies, because that drives overall growth in the world.
So the Inflation Reduction Act supporting sales in the United States. Europe is going to be sluggish, they said. So there's some concern there, saying that you really need Europe to match China and the United States in terms of what they're doing in terms of supporting this industry. But the big unknown is going to be China, not just demand, but also an escalation in the geopolitical tensions. This is something they've put out on the outlook as something they're concerned about. It's their biggest market. So if there is a substantial deterioration there, it'll have a very material impact on Mercedes.
All right, Oliver, thanks very much. Excellent interview. You can hear more from Oliver's interview with Ola Kalenius throughout the day on Bloomberg Television. You can also see it in full on Bloomberg.com. Now, a bidding war could be brewing for Manchester United. Sources have told Bloomberg a consortium led by Qatari Royals is preparing a roughly $6 billion opening bid to acquire the English football giant from the U.S. Glazer family. Joining us now is Bloomberg's Joe Easton. So, Joe, what's the sense of whether the Qataris will win this bid for Man U? Don't they already own PSG?
That's right, Matt, they do. So they do own the French team, the French Giants there. But in terms of for Man United, it looks like a really punchy bid. You mentioned there $6 billion. Bear in mind, this stock was trading at around $4 billion in terms of market cap before that report broke. So it would be a 50% premium. And we have to take into the fact that that stock doubled since November, so it rose around 100% since we got the news that the Glazers would be looking to sell. The other competing rivals would be Ineos, which is owned by the British billionaire Jim Ratcliffe, and you'd have to question whether they would be willing to put that size deal to the board in terms of a sports investment for that company. The third one to mention is Saudi Arabia. They already own Newcastle here in the UK, so there'll be a potential conflict of interest in terms of Saudi Arabia owning two big clubs in the UK. That would be looked at by the footballing bodies, I think.
And so then, Joe, I mean, what does this mean for Manchester United fans? I don't know if you're a fan yourself, but I mean, what is it that we're looking out for, considering now this bidding war that's sort of brewing at this point in time?
Yeah, so I think, I mean, I'm a Chelsea fan, first of all, so I'm hoping that they probably don't have as much money to spend. But I think, so Man United say that they have around 1 billion fans across the globe. So the idea is that they would be able to monetize that. They currently make around $500 million in revenue a year. So they're making about $0.50 per fan, which isn't a lot. And if you think how the landscape of football has changed in terms of how that's consumed, in terms of social media, Amazon showing games, there's clearly a lot of money to be made. And from the fans' point of view, they would hope that that comes back into the club. But then they would also need to control their wages, which has been the big Achilles heel for them. Players like Ronaldo, who's now left. paying huge amounts of money for those players. They can keep that down, keep putting money into the club, it would be positive.
All right, just pushing those prices ever higher, though, in terms of the entire club. Joe, thanks very much for the wrap. Joe Easton there talking to us about Man U and telling us that he loves Chelsea. Now let's get a look at some of the stocks we're watching in the pre-market today. A lot going on here. First of all, Moderna, the flu vaccine that they are pushing there yielded mixed results in a final stage trial, not doing as well for flu B as it did for flu A. That raises questions about the drug maker's plan to seek U.S. approval for a flu shot based on the messenger RNA technology. The share's down 5%. Texas Roadhouse reported earnings per share for the fourth quarter that missed the average analyst estimate. They had 89 cents in earnings. We were looking for 103. DoorDash, though, beat analyst estimates with earnings through cost-cutting efforts and as consumers continue to order pricey takeout, although apparently not enough from Texas Roadhouse. And DraftKings posted fourth quarter sales that beat expectations, raising its revenue guidance for the current year to as much as $3.05 billion. It also forecasts a much narrower loss than had been anticipated. Jen?
Right, a lot to look out for, Matt. All right, coming up, it was a wild year for hedge funds in 2022. We're going to talk about the year's biggest winners and losers in just a few minutes, and we're also going to speak with Laura Cooper, Senior Macro Investment Strategist at BlackRock. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Jennifer Zabasaja in London. Anna Edwards is off today. Now, Saeed Haider has joined Bloomberg's list of top earning hedge fund managers after personally raking in $859 million last year. Our latest Big Take looks at hedge fund winners and losers of 2022. Bloomberg's Charlie Wells joins us now. And Charlie, I was surprised to learn that does not make him even close to the best earning hedge fund manager of the year.
Matt, top spot goes to Ken Griffin of Citadel, bringing in over $4 billion in 2022. That is more than double the number 2 spot. That was Steve Cohen of Point72, who brought in about $2 billion. And you mentioned Zaid Haidar, and that's a really interesting addition to this list. He came in at number 6, almost $900 million, and he is a macro fund manager. Really interestingly, made a strong conviction call in 2022 on some of those leveraged rate bets, and that really paid off. He brought a return to investors last year of 193%, and that really brought him a lot of money as well as his investors.
And Charlie, when it comes to those that lost money, I'm not going to call them losers, but they lost a few millions. I mean, is there anything that connects all of them together? I mean, what is it that sort of unites their decrease in salary last year?
Jen, that's a really kind question, I would say, to people who are nursing some of these losses. And look, for a lot of these long, short fund managers, they really had a difficult 2022 and not a very lucrative one. So I'm talking about people like Chase Coleman of Tiger Global. You know, he lost $1.7 billion in 2022. Dan Sundheim of D1 Capital losing $1.1 billion. And it's really striking, and it just shows how quickly things can change, because Chase Coleman, just a few years ago, was actually at the top of this list.
We should note that we do this every year, so we'll be back. We'll have you back next year. Thanks to Bloomberg's Charlie Wells for joining us today.
Yeah.
All right, and you can find all of our Big Take stories on Bloomberg.com and on your terminal at NI Big Take Go. This is Bloomberg.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far. But if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Jennifer Zabasaja in London with Matt Miller in New York. Anna Edwards is off today. Now, keeping you up to date with the news from around the world, here is the first word. First up, in Ohio, there's growing criticism over the response to a train derailment that spilled hazardous chemicals in a tiny town. The CEO of Norfolk Southern has pledged to ensure the safety of residents of East Palestine, Ohio. That could cost millions of dollars. The train carried chemicals linked to liver and lung cancer. Also, President Biden expects to speak with China's Xi Jinping soon about that Chinese balloon shot down by the U.S. The president says he hopes, quote, to get to the bottom of this. At the same time, he said he makes no apologies for taking down the balloon. The dispute has highlighted just how fragile relations are between the U.S. and China. Expectations are mounting that the UK and the EU will reach a deal on post-Brexit trading arrangements in the coming days. Prime Minister Rishi Sunak traveled to Belfast to talk with the region's parties. UK and European Union negotiators are looking to resolve the dispute over the Northern Ireland Protocols, the part of the Brexit deal which sets out trade policies. And finally, the federal judge overseeing the fraud trial of FTX co-founder Sam Bankman-Fried is threatening to send him to jail. Judge Lewis Kaplan wants severe restrictions placed on Bankman-Fried's use of electronic devices and apps. There's also concern over his use of encrypted messaging app Signal to contact FTX's U.S. General Counsel, a potential witness in the case. And Matt, I believe that Sam Bankman-Fried actually says that he was using the VPN to watch the Super Bowl, to watch football. So it's going to be interesting to see how this plays out, considering what he said.
Yeah, right. Like, it's okay for him to illegally tune in with a VPN. First of all, Jen, just a quick co-hosting tip on this program. Whenever we refer to Ohio, we always say the great state of Ohio, because eight presidents are from Ohio, and it's the official farms team for New York City, the capital of the world. So that's just one point on the great state of Ohio.
Okay.
No, that's how everyone feels. No. Everyone in this program. Secondly, Sam Bankman-Fried, he's allowed to use a VPN to pretend he's in a different place so he can watch an NFL game. Is that okay, even if you're not on a $250 million bail package? And also, he's allowed to use Signal to send private messages that can't be detected by the government. How come he's allowed to do all this stuff?
So you think this should not be allowed? This should have been outlawed going forward?
I would say give the guy like an Atari 2600 and a beeper, and that's it. I don't see why he gets all this, and also we say $250 million bail package all the time, but I don't think everything he's put down even amounts to like $5 million, so I don't even know why we use that gigantic term. I guess it's just to make it a little more dramatic.
Absolutely, yeah. He can miss out on some of these big cultural events considering what's happening.
Yeah, and I mean, well, I wouldn't want anyone to have missed out on the Super Bowl. I hope you were able to watch it from London. Coming up, Laura Cooper, senior macro investment strategist over at BlackRock. She's going to talk us through these markets after the continued beats on inflation. We saw CPI and PPI both coming in hot, and after all the Fed speak that we've had and what we're still waiting to hear, this is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site, whereas this we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
This is Bloomberg Surveillance Early Edition. Here is what you need to know today. Hawks at the Federal Reserve make the case for bigger interest rate hikes. They say the central bank should be prepared to move higher and hold longer. Also, American shoppers are using their credit cards more than ever before. Credit card balances have hit a record high of almost $1 trillion, and delinquency rates, they're up as well. And finally, shares of Mercedes-Benz are rising after the German automaker announced its first buyback in 15 years. We're going to hear from the CEO and continue to talk about this. I'm Jennifer Zabasajja in London with Matt Miller in New York. Anna Edwards is off today. Matt, we were talking about Mercedes. We're going to continue to dive into that and take a look at what the markets are doing before the open.
Yeah, I'm pumped. We're going to hear more from Mercedes CEO Ola Kalenius. We're also going to hear more from GM CEO Mary Barra. A lot of auto news in the markets for us to digest on this Friday. Let's take a look at what's going on in the markets. We were down more than 1% on the S&P and the NASDAQ yesterday. We're looking at S&P futures that are off again this morning, about 0.6% down to 40.73. By the way, 40.75 is strategists' average year-end target. And remember, we still have 10 months and 1 week to go until the end of the year. So we're already there. That may be concerning for some investors. We are seeing selling bonds after all this very hawkish Fed talk, and the yield now going up to as near as damn it, I believe is what the British would say, to 390. Right now, 389.99 to go out 5 significant digits. The Bloomberg Dollar Index rising today. That's no good for risk assets. We're up to 1250 almost. That's still 100 points off of the high that we saw last year, but the dollar index has erased all of its gains for 2023. And I should point out we're seeing yields on government debt at the highest level this year, from the 10-year to the 2-year here in the U.S. Bitcoin is falling today. It hit almost 25,000. Now it's back down under 24 at 23,732. But taking a big hit also on this Fed talk and as U.S. regulators crack down on Bitcoin businesses. Let's take a look at some of the pre-market movers. Moderna is one of the big losers this morning. Its flu vaccine had mixed results in a final stage trial. That raises questions about its plan to seek approval for a messenger RNA technology flu vaccine. Apparently it didn't work very well for flu influenza B. It works very well for flu influenza A, but it's got to do both. Texas Roadhouse also down this morning, reporting earnings per share for the fourth quarter that missed the average analyst estimate. We were looking at 89 cents. We were hoping for 103, so a pretty decent miss. And DoorDash beat. DoorDash is the delivery business. Earnings were better than the analyst expectations. They're cutting costs, and also consumers are buying pricey takeout. So at the higher end of the spectrum there. DraftKings also beat. Fourth quarter sales were ahead of expectations, and DraftKings raised its revenue guidance for the full year to as much as $3.05 billion, plus forecasts a much narrower loss that puts them in a good place, and that's why the shares are up more than 6% in the pre-market. Valerie Teitel has a check on what's going on in European markets, what we heard from Isabel Schnabel, and also a look at delinquencies. Valerie?
Yeah, sure. Across the European fixed income space, we are weak. We're seeing German two-year yields rising nearly 6 basis points. We did have that hawkish commentary from the ECB, but this is really reacting a lot to what the U.S. did yesterday into the close. I say that because euro is lower on the day, so dollar strength is really taking over, so the higher yields across Europe are not being reflected in a higher euro. The stock 600 Europe, that's also down nearly 0.6%, taking some beating going on from the equity weakness into the close yesterday. And I've got NatWest up on here. They reported today, even though they announced an £800 million share buyback and their net interest margin came in higher, analysts were more focused on the reporting of higher costs, and they guided profits slightly below expectations. So that's NatWest down nearly 7%. It's the worst performer in the FTSE 100. But speaking of consumer lending, I want to shift back over to what's going on in the U.S. and talk a little bit about debt delinquencies. Now, this data and this chart comes from that quarterly report from the New York Fed released yesterday, and it showed that U.S. credit card delinquencies are on the rise. And the important thing to note here, Matt, is that it's especially in the rise amongst the young people. What do we know about the young people? Well, they've already gotten student loan forgiveness, right? So this is happening. These delinquencies on young people's credit cards are rising, even though their student loan forgiveness, that continues until August this year. So should we be worried about these delinquencies starting to tick up? We have a lot coming from the U.S. economy in terms of these rate rises. Perhaps this might be a little canary in the coal mine as we start seeing these credit card balances balloon and delinquencies rise.
That's what I'm talking about, a canary in the coal mine. Thank you very much, Valerie Teitel. Joining us now is Laura Cooper, BlackRock Senior Macro Investment Strategist. Laura, I confused and concerned everybody with my Jaws tune earlier, but it does seem like this is the coming of the recession, right? We're hearing about this in delinquencies in auto loans, delinquencies in mortgages, delinquencies in credit card payments, and now $1 trillion total balance. Does it worry you?
Well, I think it probably is a little bit concerning that we are starting to see the deterioration in the markets in terms of what we're seeing on the economic data. But ultimately, this is still an environment where we've clearly seen robust U.S. economic data. So if anything, I would argue that are we starting to see signs of that earlier monetary tightening start to feed through economic activity? It's probably too soon to declare that. But I think ultimately it does set up for, as you mentioned, yes, a U.S. recession, but likely delayed to the latter half of the year. And I think markets still have some catch-up in terms of price action to reflect that deteriorating backdrop.
What do you think about the Fed in terms of higher for longer? We heard from a couple non-voting members, but it would make sense given this hotter inflation data we're seeing. Do you expect a terminal rate of like 5.50, and will they hold well into 2024?
Well, I think that the fact that we did see this exceptionally strong data, whether that come through in the retail sales or just signs that inflation pressures continue to remain sticky, really does suggest that, yes, the Fed is going to have this higher for longer kind of cycle. We do expect that the risks to the terminal rate are likely higher than our current expectations around that 5.25% mark in the back of that. But really what's been interesting is what's happening in markets. So there was this disconnect between Fed commentary and what we were seeing in terms of markets price and easing. We've now seen kind of rates markets catch up to the Fed commentary. Now I think what we're starting to see is equities catch on to that as well. The fact that, look, this could actually be a Fed that has to tighten much more than market expectations because this economic data is proving quite resilient.
And Laura, can we talk about currencies? I mean, Matt mentioned that the dollar erased, or it's at its high 6-week high, erased its losses for the year. I mean, does that rally continue based on the data that we got this week, based on the commentary that we got from the Fed speak this week?
Well, I think the dollar is likely going to struggle to sustain the pace of gains that we've seen year to date, because this is largely being driven by the front-end repricing. As we do see rates markets price out that easing, start to pay attention to that Fed commentary. And when we look at something like the euro-dollar cross, the fact that it has come under pressure in February, but yet yet we did have those comments from Isabel Schnabel suggesting that, look, inflation risks are still tilted to the upside. The European economy does show resilience. That could actually tilt towards an even higher terminal rate for Europe, which is probably has more room to be priced in, and the potential for the Fed to pause ahead of the ECB. So I think those key tailwinds for the euro have yet to play out.
What does that mean for your investment strategy then? I mean, what are you paying attention to specifically?
Well, I think ultimately at this point, we're still quite cautious on the broader equity backdrop across developed market economies. If we think at what's driven the rally year to date, we think it's largely because, yes, markets have front-run a lot of the positive news around this European improved outlook, past peak inflation, China reopening, but as well, if we think about a lot of the moves have been kind of the short covering. We've seen a lot of options derivatives kind of underlying this price action. So ultimately, we struggle to see what could be that further catalyst to continue the strength. And I think the fact that we are starting to see earnings come in fairly mixed, that is going to feed into kind of still a cautious position on equities.
Laura, we had, at the beginning of the year, everybody was so psyched for Europe. It was finally going to be better off than the U.S. because they didn't have any of these big tech stocks and their heavy energy. And people were pumped about emerging markets as well. Those two trades seem to have faded a little bit. What's your take on regions?
Yeah, and it's actually been captured quite well in terms of when we look at flow data. So sitting where we do at BlackRock, we do have iShares, which is a really good proxy for global risk sentiment. And we've actually seen Europe in January had the largest inflows in more than a year. We had EM as well gather that momentum that we saw through 2022. And interestingly, that came at the expense of drawdowns in U.S. equities. So clearly investors were taking this barbell approach where they were seeking those kind of higher beta exposures in Europe and EM, and also that high quality credit, but at the expense of the U.S. Now, the fact that the U.S. has outperformed Europe more recently, I think that does suggest that investors are going to go back into that higher quality U.S. stocks as we do see some of that momentum in Europe fade, because this is still a challenging economic environment, and I would argue that the inflation risks are actually probably greater in Europe than they are in the U.S. That's really yet to be reflected in prices.
What specifically in terms of inflation risk? I mean, what is it that you think is really going to drive the overall global inflation picture moving forward?
Well, I think ultimately when we look at Europe, for example, the fact that the economic growth has come in much better than expected, and so markets are kind of priced for this inflation to go well below 2%, but this economic resiliency suggests that inflation could come in actually hotter. We start to see kind of that further tightness in the labor market spilling into wages, consumer confidence starting to resume. That could actually enable the ECB to go even higher for longer. And that's really the key risk that could potentially trigger the European economy into a recession, albeit delayed later this year.
Wow. Laura Cooper of BlackRock, thanks as always for being here, and thanks for your time. All right, coming up, the evolution to electric vehicles speeds up. We hear from the CEO of General Motors and Mercedes on the rising demand for their electric vehicles. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for the, if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Jennifer Zabasaja in London. Anna Edwards is off today. Now, General Motors says its strong sales of gas-powered vehicles are paving the road for their future in EVs. Bloomberg's David Weston spoke exclusively with GM CEO Mary Barra on their sales strength and where the company is heading.
When I look at our portfolio of internal combustion engines, I'm really excited about it, and they're doing well. The customers are responding. I mean, you know, we still see very strong demand for our trucks, our full-size SUVs, the Chevrolet Suburban and Tahoe, the GMC Yukon, and the Escalade. Again, we can't build enough of them, and so I'm excited about the demand. The customers are really responding, and that kind of response, and you know, especially when they want to buy up-level models, is really what is giving us the ability to generate the profitability. We had strong profitability last year that allows us to continue to invest from an EV perspective.
You are in investment mode. You're putting tens of billions of dollars into electric vehicles, and yet you've really pledged you're going to maintain margins to the best of your ability. You have to do that in part by costs. And I wonder, any business I've ever seen, you're always spending too much in some places and too little in others. As you look forward to the future of General Motors, where do you think you need to spend more? Where do you think you need to spend less?
Well, I think any part of the business can be made more efficient. Even the areas when you're growing, you can still look at how do I grow efficiently. One of the things I always tell the team is, I want you to be scrappy. Pretend it's your own money and it's your last dollar. How are you going to spend it? And getting that kind of creativity, I think that's when people do their best work. And so, clearly we're optimizing our internal combustion business, but making sure we're giving the customer everything they want and more, surprise and delighting them. But we found that we can do that with a lot less complexity. For instance, I mentioned the Chevrolet trucks that will have one engine. And so, that allows us to do the vehicle in a very efficient manner, but still meet the customer needs. But we've also found that, through COVID, we found we could take cost out, reduce bureaucracy, and now we've got to, continue to get at that. And that's why we announced with earnings, even though it was record earnings, we announced that and committed to take $2 billion out of structural cost between 23 and 24, and I know the team can do it.
That was GM CEO Mary Barra speaking with Bloomberg's David Weston. And another driver in the EV race, Mercedes. Bloomberg's Oliver Crook sat down with the Mercedes CEO earlier today.
I think we need to look at the macro environment and what the economy is going to do. It's natural that central banks around the world, when inflation has been rising for the last year or so, to react with interest rate hikes. And that is designed to clearly put a little bit of a cooling effect on consumption and get the inflation down. So we're watching macro, and that is why we take a slightly cautious view on what the market will do and are guiding for sales around the same level as 2022. But at the same time, our business model is very robust with a guidance of between 12 and 14% return on sales. If we execute well, 2023 can be another good year for us.
And so you cite the consumer there being squeezed a bit. Are you seeing that change in kind of the cars that people are choosing to buy? Are you seeing a change in consumer behavior due to that squeeze?
Not yet. We have been seeing on nudging up in the segments that we're in, and also making sure that our top-end offering is very attractive. In fact, in 2022, our top-end vehicle sales grew by 8%, and we are looking at another slight growth on the top-end side for this. So managing your portfolio and making sure that you find the right operating point in the market, I think will be key for 2023.
And on that subject, you cut prices for the EQS over in China. How has that reacted in terms of sales? Has that worked, and what went wrong there?
What we're trying to do with products around the world is very much like other luxury companies do, is ensure that you have somehow level pricing around the world so that equivalent products have roughly the same price levels in the main markets. That's what we did with 2 models in China. Last year, our battery electrical sales grew by just shy of 70%. This year, we will be in a position to double our sales of electric vehicles. So the future direction going electric is set, and we're executing on it.
And China is your biggest market. Obviously, we've seen tensions rise. It's one of the things you cite as a concern in your outlook. How is Mercedes preparing in case things further deteriorate? What is your plan there?
Well, the Mercedes model, of course, is also based on the ability to export and import across the world, driven by the WTO rules. What we have learned from the COVID and the supply chain issues that we had mainly on the semiconductor side over the last couple or 3 years is that we need to create optionality on the supply chains, and working on that in our main verticals.
Mercedes CEO Ola Källenius there, and we heard from the General Motors CEO Mary Barra. My dream car would really be an amalgamation of the two. I'd like to take a Mercedes AMG GT and drop in the Z06 5.5-liter flat plane crank V8, and that would be absolutely amazing. But Jen, I was super excited to hear from Mary, especially yesterday when she talked with David Weston. It seems like they're coiled spring that's just about to explode. They want to sell $50 billion worth of profitable EVs by 2025. That would put them well above Tesla, 1 million EVs a year. And I think it's a pretty exciting story as they get ready to roll out a ton of different models.
Right, Matt, but as we've been talking about all hour, I mean, we still have a number of consumers who are just raking up a ton of credit card debt, excuse me. So who are these consumers that are going to be buying these, especially when you consider cars, Mercedes in particular, saw a 43% jump in prices. So it'll be really interesting to see sort of how and if the consumer responds to what Mercedes and also GM are saying.
Yeah, it's a very good point. In fact, David Welch and Keith Naughton from our Detroit bureau put out a story a couple days ago pointing out that the average consumer car payment right now is $770 a month. That's pretty punchy, especially when a lot of households need 2 cars. So those prices just keep rising, and I can't imagine how consumers are keeping up with that kind of affordability or lack thereof. Coming up, the Munich Security Conference kicks off today with the war in Ukraine expected to dominate discussions. We're going to hear from Emmanuel Macron. We're going to hear from Olaf Scholz. We're going to hear from Maria Tadeo live in Munich next. This is Bloomberg.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish, there's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Jennifer Zabasajja in London with Matt Miller in New York. Anna Edwards is off today. Now, here's a look at what's ahead today at 6:30 a.m. Eastern Time. The ECB's Francois Villeroy will comment on monetary policy and inflation in Paris. At 8:30 a.m., Richmond Fed President Thomas Barkin will speak to reporters at an event in Virginia. And a short time later from that, we'll hear from Fed Governor Michelle Bowman speaking at a banking conference. And also today, the Munich Security Conference kicks off with the war in Ukraine taking center stage. Earlier today, we heard from Ukraine's Deputy Economy Minister. Take a listen.
Economy suffered a lot because it's obvious that the challenges we're facing are not coming without consequences. So eventually, we must admit that the economy shrunk for at least 31% in GDP. We do anticipate little growth in the margin of like 2% at the end of 2023.
All right, Maria Tadeo is with us now out of Munich. She's at the security conference. That's a gig that I used to have, and I think it's an amazing conference to attend. So I hope you have a great couple of days, Maria. What's going on right now?
Yes, Matt, and what a year it has been. Remember, just essentially this time ago, a year ago, Volodymyr Zelensky was in this hotel you see behind me, telling the world that Ukraine did not want a war but was ready for it, and Russia, which denied until the very last second that it would invade the country. Now you fast forward to this edition, and what you have is a war that's now almost in its first year of duration. You have a full-scale invasion and a lot of questions about the future. Now, the mood here, Matt, it really is to me one of uncertainty. What happens next is a question that I ask every official, and obviously there's no clear answer to that. When will the war end? Everyone will tell you a different story. And then secondly, there's also concerns about this idea of the new Russian invasion. Remember, the head of NATO said you don't have to wait for the spring. The offensive is in many ways underway. Now, this morning we are going to hear from the French President Emmanuel Macron, who just walked behind us. The motorcades that you see here belong to the French President at this point, and the German Chancellor, who's also said to speak. An important conversation for Germany. Remember, the country has said it made mistakes when it comes to Russia, and we'll have to learn from them.
All right, Maria, thanks very much. Maria Tadeo at the Munich Security Conference, always a really important one, this year especially so. She's going to be speaking with the UK Prime Minister Rishi Sunak in a panel at the conference soon. This takes place on Saturday at 12 p.m. UK, 1 p.m. CET, and we'll have the highlights on Monday. This is Bloomberg.
institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
It's just much harder to get a good read on the market, right? These moves are amplified, so you can't see that.
You've had a reversal from really extreme positioning at the end of 22, and that hasn't clearly ended yet.
Let's get some confirmation of the trend from a few more data points that hopefully align in one direction, and then get on that train.
Yes, inflation should ultimately come down. It's just going to take time. This whole cycle is taking time.
We at the moment have, in annualized terms, very little growth. We are kind of in a winter stagnation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
You're still in your prime, Tom.
You were going to go there?
No, just telling him something.
Yeah, well, we hide the walker when we go live.
I am.
We're all in our
to know.
prime.
That's how we should begin programming. Every day.
Every day.
From New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures down by 0.75%. We have a new high for the year at the front end of the yield curve. We are through 470 TK a little bit earlier this morning. 470, and we're talking about 50 basis point hikes again at the Fed.
It's moving. I've been remiss here. I'm looking at the BTMM screen, and that 6-month T-bill goes, that's 497 still, just not through 5. But, you know, we come into the end of this week, and we're thinking about staggering to March. There's an inflation of equities back, and you know what? You're right. It's just about short rates gaming the Fed.
Hard data has been tremendous, so the pushback is as follows. Pushing back the recession calls and introducing a higher terminal rate, a higher peak rate at the Federal Reserve. Jan Hatzius at Goldman, Lisa, you see that? 525 to 550. Their new call, they throw in an extra hike in June.
A lot of people are following along with that, including Fed officials, perhaps they're not the non-voting members, but they're saying perhaps we should have raised by 50 basis points at the last meeting. I'm talking about Jim Bullard and others, and then coming out and saying, well, perhaps we have to think about another 50 basis point rate hike. Putting this all together, there is a real angst here. Does this Fed have to torpedo the economy in a way that perhaps riskier securities haven't been preparing for? That is the angst that you're seeing reflected in markets this morning.
Torpedo the economy is, I'm going to game out 3.1% Q4 readjusted GDP. What's Q1 GDP going to be? It's not a recession. It's not tanking. It seems to be pretty buoyant. I thought Michelle Meyer with MasterCard yesterday, she's got the pulse of it with all the charge card stuff. And
sure.
I'm sorry, I think GDP is still there.
I'm going to drive you nuts. So if it's no landing in the first half, Mr. Hartnett over at Bank of America says it's hard landing in the second half. And this is what Barclays said this morning. Persistent inflation means there is no free lunch. Higher for longer rates is the cost for resilient growth. That's the cost for growth, and ultimately they think equities are going to have difficulty rallying too much from here.
A lot of people agree. There are some who are pushing back and saying that if you have any kind of selling activity, it's time to buy, including our next guest. But there is a question that I have about how long you can get this sense of both good growth is good for equities, and also higher than expected inflation's just fine.
Do you think the chairman, if he spoke today, of the Federal Reserve would turn around and say the disinflationary process has started?
Do you think
he'd
clue.
repeat that?
I have
but
no
isn't
clue.
that part of the story? Because him uttering those words encouraged a fair bit of this rally so far year to date, or at least validated it for a lot of people. And here we are, maybe pushing back on that statement, and maybe they've got to walk it back too.
I spent a chunk of time yesterday thinking about the fact that we're hearing the hawkish prognostications from non-voting members. Why is that, right?
Messed
is this
up Bullard,
basically,
yeah.
That's a
why
real
is
nuance.
that?
That's
Why is it
really
the
well
people
said.
who don't
Yeah.
have truly a seat at the table are the ones that can be the true naysayers?
Why can
whereas the people who
Clarida
say
on
that-
our Fed show say the things he says? Because there's an institutional responsibility to sing from the hymnal, to keep the ultimate fear, which is, are we unanchored? Are they unanchored? And as Rogoff said this week, they're not going to lift from 2%. But everybody from Adam Posen to Olivier Blanchard is saying, what's it, 2.2? 2.8, 3.2, whatever.
I agree it's important to point out that Mester and Bullard aren't voters, but non-voters still attend, contribute and participate in the meeting. You'll still see some of this play out in the minutes. And the minutes get even more fascinating now, because we thought the minutes would be the stage for a discussion of the pause.
I'll read the minutes.
And now all of a sudden, Lisa, there might be a different discussion in the minutes. Yeah, let's see you read the minutes. There was a comment from Bullard yesterday. It wasn't just about the 50 basis points. There was a comment from Jim Bullard of the St. Louis Fed yesterday that got my attention. He said he's pushed back against the idea of long and variable lags. He thinks it's not the 50s, 60s, 70s anymore, and he's pushed back against that idea. So let's see if the minutes, Lisa, are a stage for that debate to play out with a little bit more colour.
And then what's the read-through to markets, right? Are stocks accurately pricing in the sense that the Fed might have to go well beyond 5.25%? That, to me, is something that's also the unknown here.
If Brian Levitt has to wait any longer, Tom, he might have nothing left to say. So I'm going to whip through the price section briefly.
Michigan lacrosse for this
Equity
spring.
futures down 0.8%. Sit tight, Brian. We'll be there in a second. In the bond market, yields are higher by 4 basis points. 390 on a 10-year. 390 on a 10-year is just a phenomenal turnaround. On a 2-year yield, higher by 6 basis points. We are through 470 on a 2-year. That, Lisa, is a new high for 2023 on a 2-year yield.
Yeah, and it really comes as we hear all of this Fed speak, in particular responding to the data. Let's talk about what the Fed speak we're going to get today. We're going to hear from Richmond Fed President Tom Barkin, again, following his conversation on Bloomberg Television, as well as Fed Governor Michelle Bowman. Do they reiterate this hawkish feel? Do they talk about 50 basis point rate hikes back on the table? Today, we also see the Munich Security Conference beginning over in Germany, and we're going to hear at 8:45 a.m. from Valdis Dombrovskis, the European Commission commissioner, who is going to be speaking with our own Maria Tadeo. We can really get a sense, perhaps, of the tensions growing between the U.S. and Europe, in particular with respect to trade, with respect to the Inflation Reduction Act. And at 11:30 a.m., the Bank of France Governor François Villeroy de Gallo is going to be speaking, and I'm very curious to hear what he says, because we heard from Isabel Schnabel over the past couple of hours, who really reiterated this hawkishness, a sense that perhaps the market is underestimating how much inflation there is, and perhaps underestimating how far the ECB will have to go. So again, John, we've been talking about the U.S., but this is also very much a European story.
You've got to tell us who's speaking again.
I gave her the pronouncer on that.
Was that
Lisa, who is speaking for the ECB?
François Villeroy.
I can't pronounce it either, but look out for that.
They keep a list. Marty Schenker of Bloomberg Television, folks, keeps a list by his desk of my mispronunciations.
Oh, that was gold.
It's 6 feet 5 inches tall.
This is gold. I remember when you and I first started doing the radio show together, and if there was a complicated name, Tom would do a really, really long introduction for the guest, and then he'd turn around and just go, John?
True, so true.
And then he'd hide behind the desk in tears as I try to pronounce it. Brian Levitt is an easy one to pronounce. Thanks for your patience, Brian, for being with us. Global market strategist at Invesco. Brian, we've got some weakness in this equity market. Is it weakness you want to buy?
Yeah, we're going to probably have some pullback in market here. I mean, the market was priced for a soft landing, was very enthusiastic about a soft landing. And we had called this year a roadmap to recovery. So you could get some retracement of some of the gains here now that inflation has come here in hot and there's more expectations of policy tightening. But it depends on your time horizon. I mean, for me, I'm a FOMO guy. I don't want to miss out on what will ultimately be a nice recovery in these markets. Markets tend to do very well in the couple of years after inflation peaks. So short term, some challenges, but intermediate term, markets should do quite well.
Brian, into the weekend, people are readjusting to an extraordinary beginning to the year. And as you mentioned on FOMO, fear of missing out, the bottom line is people are going, I can't be in cash, I've got to play. Where do you play? Quality?
Depends on your time horizon. So if in the near term, if the Fed has to keep going, you'd want to be a little bit more defensive, higher quality, more low volatility. But the challenge is, at least from my perspective, I ultimately believe inflation will come down, the Fed pause will come, and will kickstart another one of these moves. So if you're looking out over the year into what will ultimately be, in my opinion, a more of a sustained recovery in markets, that means you want to be more value, more small, international. So it's a time horizon thing. Could we see some retracement here? Absolutely. But over the next couple of years, I'm looking sustained recovery in markets, and markets looking forward to a new economic cycle.
Brian, given the sense that you are constructive, does that mean you're also constructive on big tech, despite the rally that we've seen, which really has been the leadership behind the rally we've seen year to date?
Well, the move in short rates isn't going to be helpful. I mean, we saw that in 2022, as soon as rates were adjusted, valuations had to come down, and so the move in rates isn't going to be helpful in the near term. You may see another valuation adjustment. So I would say, when investors have been underweight value in their portfolios, they've been overexposed to growth. I would use, these opportunities, particularly if there's a pullback, to try and incorporate more value in the portfolio, more equal weight rather than market cap weight. It's going to be a different environment than what we saw in the prior cycle, which was very low nominal growth. The other side of this will be a somewhat higher nominal growth environment.
Brian, are you leaning into the all bond portfolio, this idea that everyone and their mother's going into bonds right now? I was just looking at flows, and the first beginning of the year has actually been the greatest amount of flows going back to 2004. Are you on that?
Yeah, I mean, why not? This whole idea of the death of the 60-40, what the Mark Twain line that it's grossly exaggerated. I don't think he actually said that. This is more of a golden age. If you look at things like high yield or bank loans where you can get 8%, I mean that's like an equity like return without taking on the similar historical risk. In the short end, getting these types of rates look quite good. Of course, you have reinvestment rate. I bet people will look back at this at some point and say I should have locked in the 10-year. But yeah, this is a very good opportunity to add income to the portfolio.
The reinvestment risk is a real risk that we've tried to discuss over the last couple of months, and it's something we've got to discuss even more. Yeah. Hey, Brian, I love that line. I'm a FOMO guy.
That's what I wrote down.
Isn't that just brilliant? I'm a FOMO guy.
That's just embrace it.
Brian Levitt of Invesco. Brian, thank you. Not many people admit to that, I
absolutely love that, because instead of saying, all those people, it's FOMO, the meme stocks,
sure.
etc.
I'm one of them.
I'm one of them. Bring it on.
I think your observation on bonds, where the popularity's there, Ben Laidler goes the other way and notes the equity market, how unpopular it is, and has equities underweight, like back to 2008. I really didn't realize it was that gloomy.
Well, the investment risk, Tom, as you know, is like you take a 6-month yield, 6-month T-bill, and pick up 5%. Where are you in 6 months? Can you do the same thing again?
There's a comfort there.
Or do you want to go further out along the curve and lock it in for a longer period of time? We'll try and pick up on that story a little bit later. I want to pick up on Dia. The stock is up at a pre-market by 1.4%. TK, you keep talking about the earnings. Full year net income, this is their outlook now, 8.75 billion to 9.25. Previously, they'd seen 8 billion to 8.5, so that is a lift from Dia.
Yeah, it's a lift from Dia, and there's an affection here. In the CFA Level 1, in the accounting textbook, Dia is what you use. You enjoy flunking equipment leasing by studying equipment leasing at John Deere. So there's a real affection always when Dia reports, and they're real concise about it. Look at the numbers. They're a lift.
It's a beat and raise. The stock is up by 1.4%. And coming up, we'll talk about the earnings with Bob Dole. Looking forward to that. From Crossmark Global Investments, we'll do that in the next hour. From New York City. What are you drinking?
Tang Zero. It's prime.
Beautiful.
It's prime.
You energized? Ready to go? Nice.
Great.
Great. All that energy. Wonderful. This is Bloomberg.
Keeping you
Up to date with news from around the world. With the first word, I'm Lisa Mateo. Two of the Federal Reserve's most hawkish policymakers are signaling that they may favor returning to the bigger interest rate hikes to fight inflation. Cleveland Fed President Loretta Mester said she saw a compelling case for a 50 basis point hike at the most recent Fed meeting. Now, that view was echoed by St. Louis Fed President James Bullard. President Biden expects to speak with China's Xi Jinping soon about that Chinese balloon shot down by the U.S. The president says he hopes, quote, to get to the bottom of this. At the same time, he said he makes no apologies for taking down the balloon. The dispute has highlighted just how fragile relations are between the U.S. and China. Ukraine's ammunition and weapons gap will dominate the Munich Security Conference, which began today. EU and NATO officials have called for an increase in arms production to address expected shortfalls. Meanwhile, the UK's defense ministry estimates that up to 200,000 Russian troops have been killed or wounded since the start of the war almost a year ago. Expectations are mounting that the UK and EU will reach a deal on post-Brexit trading arrangements in the coming days. Prime Minister Rishi Sunak traveled to Belfast to talk with the region's parties. UK and European Union negotiators are looking to resolve the dispute over the Northern Ireland Protocols, the part of the Brexit deal which set out trade policies. In Germany, shares of Mercedes-Benz are higher. A share buyback and strong fourth quarter performance helped offset its projection that earnings will slip this year. Mercedes' $4.2 billion buyback is its first in 15 years. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The violation of our sovereignty is unacceptable. We'll act to protect our country, and we did. I expect to be speaking with President Xi, and I hope we're going to get to the bottom of this, but I make no apologies for taking down that balloon.
The President of the United States teeing up a phone call with President Xi at some point in the future. Look out for that. Equity futures right now down 0.8% on the S&P 500. Look out for this in the bond market. Yields up 4 or 5 basis points on a 10-year to 390.57. On a 2-year yield through 470. We have a new high for 2023. We're up by 6 basis points on a session. And it's not just the hawkish Fed talk. It's also the hawkish ECB talk as well. We heard a little bit earlier from Isabel Schnabel of the ECB Executive Board, fantastic speaker at the ECB, really, really great communication, Lisa. Always follow what she's got to say because it's so easy to understand. And I think the message was pretty clear this morning. Ultimately, she sees a risk in this market that they underestimate the inflation path.
This, to me, was actually more notable than what we heard out of Fed officials, because she was talking about how what the ECB's potential terminal rate that people have been talking about could be way too low. And she was pretty vociferous about this. This is not just one inflationary shock. It could dissipate, but it could be something much more severe.
We're now talking about 3.75 at the ECB as a peak rate. Tom, that's a change, because from a lot of people I've spoken to over the last, something like 3.25, maybe we stop there, and now all of a sudden we're pushing 4.
The shift here, and this is a Wednesday, Thursday, Friday shift, I'll let you tell me the hour, John, is all of a sudden we're paying attention again to the 10-year yield, 3.91%, dashing out to 4%. And the nuance here is that vanilla curve, the 2-10 spread, hasn't widened out like the -90, -92. It's gone the other way because the 10-year is starting to click in, and that is maybe we're a little growthier before the recession. Maybe we're just not gaming out the gloom farther out, and so you get the curve dynamics while the 10-year goes up.
That's well explained.
Did I do okay there?
I think Barclays are on board with you, Tom. Ultimately, growth is better, but the price of that growth is higher rates.
Yeah.
And that's what we're pricing in this week. Off the back of some really decent hard data in America so far, the big question we've got now is whether the February data confirms the trend in January, and TK, we'll see. Got to wait a few weeks for that.
We're going to have to see on that. What we're going to do here is dive into the politics of the moment. There's 8 ways to go, always, with Professor Schiller. Wendy Schiller is director in Taubman Center for American Politics and Policy at Brown University, her textbook, definitive. Wendy, I want to go back to Ronald Reagan. And I can remember clear when the FDR Democrat became a Republican and changed how primaries run. There was that moment, I think it was in 1978, whatever, 1976, where he was pushed aside because he was too conservative. And he figured out you run conservative and move to the middle along the election trail. That seems to be absolutely blown up. As the governor of South Carolina jumps into the race, as we see poll, John, help me here, the poll for Trump overnight, Quinnipiac.
That was Lisa who saw that, yeah.
Yeah, the Quinnipiac poll.
He's the leader, and right behind him is Ron DeSantis.
Yeah,
so
okay.
The leaderships.
It seems like, Wendy, it's all blown up. How are the primaries different this year versus what we knew with Ronald Reagan?
We don't have time for the entire explanation, Tom. As always, you ask a very broad question. A couple of things. How the Republicans structure their primary season for 24 makes a big difference to Ron DeSantis and Donald Trump. We've seen the Democrats move their calendar. Obviously, South Carolina is a big primary and a big priority now for the Democrats. What will the Republicans do? And what I'm talking about is how they divide up their delegates in the beginning. Proportional representation, which kept Trump alive actually in the early primaries in 2016, or winner take all, which would help Trump also because Trump's now a known commodity. He's got a built-in base. And if it's plurality, he'll start winning those early primaries. And that presents a challenge, if you think, for Ron DeSantis. Even though he's got Florida, that's going to be, and we haven't heard yet what the RNC will do with whether they're going to make any changes or keep things status quo.
Wendy, a lot of people are talking about how much time, and I say a lot of people, I'm saying the 2 people next to me are talking about how much time it takes for the election process to be carried out. And I'm wondering, how much room is there to change the gravitational force in the Republican Party away from Trump toward Ron DeSantis perhaps a bit more, but also potentially to Nikki Haley?
Well, the only way it gravitationally pulls towards Ron DeSantis if it's Ron DeSantis declares and starts running. I think the mistake that he might make is to wait too long. Now, you have Florida in your back pocket. You get a lot of free publicity, but it doesn't mean you're out there really connecting with primary voters. And that's what DeSantis has to do earlier than I think he's comfortable with. And then Nikki Haley's going to be out there. Tim Scott from South Carolina, he's a senator. He may get in the race as well. I think the idea is the more people can present alternatives positively, not beat up on Trump, not attack Trump, but positive alternatives without all the baggage, they're hoping they can start to pick up some steam among rank and file primary voters.
On the Democratic side, we have President Biden trying to deal with both domestic and also international issues. And the latest news on that front is that he is thinking about some sort of phone call with Chinese Premier, with Xi Jinping, the president of China. How much does this give him a bit of a difficult position to put out there, trying to both dovetail a hawkish message with a sort of a olive branch to the Chinese leadership to try to smooth over some of those relations?
Yeah, I mean, I think that he's handling this in the way that he handles almost everything. He's sort of marching to his own tune. He's got a lot of foreign policy experience. And China is an extremely important, I'm not telling you something you don't know, a very important economic partner. And he's been moderate in his response to this because, picking a fight with Russia and China at the same time, particularly China economically, we just got out of that with tariffs and, they stopped buying our soybeans. That cost us a lot of taxpayer dollars and subsidies back to farmers. There's a lot of very negative consequences to picking a big fight with China geopolitically and economically, and he's not falling for it. He's deciding, I'm going to take this slowly, one day at a time, and I'm not going to jeopardize what seems to be a renewed and healthier relationship than under the Trump administration.
Wendy, underreported is the four-base agreement between the Philippines and the United States, I'm going to say 2 weeks ago, where we're going to expand out there with investment in some form of military bases in Luzon and in the South China Sea. How important is that? What does that signal to the Navy and to China?
Well, it's extremely important. As you know, China's been making incursions into the South China Sea for quite some time, obviously rattling their saber when it comes to Taiwan. Just understanding that the United States will maintain its military presence and that it will be prepared in some way, shape, or form to block any what they consider overreach by the Chinese military and any threat to Taiwan. So I think it's a traditional move. We've been affiliated with the Philippines for a very long time, and some people would object to the nature of that relationship in its early days. But nonetheless, they have to show, the military in the United States and the president, that we are going to engage some way, shape, or form, not to give China a free hand.
When do we have this Munich security conference ongoing over in Germany? What do you expect to come out of that?
Well, I mean, I think, the whole question of the Ukraine-Russian conflict, how much weaponry we are giving to Ukraine. We've seen this in the past where we give a lot of weapons and then we lose, and then the enemy gets our weapons, whether they're destroyed or not. And it's a delicate balance. And then you've got Finland saying, listen, when are we getting into NATO? You want to expand NATO? We want to be part of NATO? Let us in already. So I think there's a lot of complications going on. And I think, Trump took advantage of this in terms of our NATO partners and saying you have to do more. And I think President Biden is doing a lot with weaponry, but you have to make sure Europe's in and continues to stay in. I think that's politically very important to President Biden.
And by Europe, really, we mean Germany, don't we? Wendy, thank you. As always, Wendy Schiller there of Brown University. Wendy, just wonderful. TK, nice broad question. Just
I did that.
That was great.
Put me
I appreciate
in my
that.
chair. I used to go to the back of the room.
Is that the first time you've been told you asked a broad question?
Oh, no.
There's been many a time. Should we turn back to these dear
I drive up to Providence and have pizza with Professor Schiller to make up for it.
They now see full-year net income at 8.75 billion to 9.25 billion. They had seen 8 billion to 8.5 billion. Tom, our story. Do you want a headline from our story? Deere lifts outlook as cashed-up farmers overhaul aging fleets. Isn't that a story?
John Deere 10-year per year track record, 19.56%.
Wow.
Wow.
Wow. Stock is up 3% in the pre-market, 415.
God, they make a good Zamboni.
55. Simon French of Panmure Gordon coming up.
life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
Coming off the back of the biggest one-day decline of the month so far, live from New York. Let's see if we add to those losses. We take some more weight off the S&P 500. We are lower, negative by 0.7%. On the Nasdaq, we're down by 0.9%. Challenged by this in the bond market, a 2-year that a little bit earlier on went through 470. Your new high of the year intraday is 471.33. That came a little bit earlier this morning. We're just off those levels, but still higher on the session by 5 or 6 basis points. 10-year, hello, 4%, getting closer. 390.38, up 4 basis points. And take a look at the euro, negative today, but some hawkish pushback from one key ECB official. Isabel Schnabel essentially communicating to market participants that she thinks, Tom, this market could be underestimating inflation. This is the pushback we're starting to witness, I think, in the last 24 hours.
Tell our American audience who she is. You've got a real nodding acquaintance with this, and I would say she's almost the heart and soul of Central Europe. Do I have that right?
A great communicator. Fantastic communicator, Tom. At the Federal Reserve, you have the Board of Governors. At the ECB, you have the Executive Board. And on that Executive Board sits Isabel Schnabel. So a key speaker.
At Jackson Hole, the elk stopped, the buffalo stopped when she spoke. She's a big deal.
She pushed back in the same way Chairman Powell pushed back at Jackson Hole.
Yeah.
Talking about the pain that we might have to go through to get inflation lower. The surprise that they're confronting at the moment is the absence of pain in early 2023 relative to what we expected in both Europe and the United States. And with that in mind, this idea that perhaps they have to go further than any of us thought.
Do we all agree it was a weird week? The week is.
I think a continuation, Tom, a continuation of what we've seen over the last several weeks, which is just better, hard data in America, a series of upside surprises.
I actually think there's been a real big shift this week. This week it's been weird, but there's been a solidification of a narrative of potentially higher rates and that this disinflationary hope perhaps was overestimated earlier in the year. That has been the big theme of this week.
To me, and John, I give you great credit for this because I think you really pushed it forward. Maybe, Lisa, you did as well. I did not. It was Peter Cheer's conversation.
It was great, yeah.
Was like lights out. Sum that for me. There's this wacko option strategy, which is like a one-day strategy.
Really short-dated options, 0 days to expiry. The theory ultimately
Sounds like my checkbook.
The theory ultimately is, and I'll try and make this super simple. There's been a lot of volume in those very short-dated options. And if you're selling a bunch of call options, you have to offset and hedge that, and ultimately you buy the underlying, which could be the S&P 500. This creates this self-fulfilling cycle of a higher market, all of the above. Anyway, I've oversimplified it, but ultimately, I think Lisa picked up on the important message in what Peter Cheer had to say yesterday, is that essentially he was conveying there is a cleaner message in the bond market than there was in equities. And you picked up on that story, and I think maybe that's the right question.
Yeah.
Right now, the bond market's sending a very clear message that both the Fed and the ECB have to do more, and now the read-through to other markets is really the issue.
A little bit less accommodative on Bloomberg Financial Conditions Index. I've been looking for a theme for weekend reading to get into February, to get towards a March 22 Fed meeting, and Simon French has handed it to me with a silver platter as he serves tea at Panmure Gordon in London. Simon, I love the concept. For all central banks, you narrow down to the Bank of England where they're declaring victory. But the idea that now comes the hard bit, And I really like that. We've gone through 18 months of whatever, and now we're at a tension point. Describe the tension point right now for BOE and the major central banks.
Yeah, the major central banks are now into a phase of where they're going to have to use judgment. It's relatively easy as inflation prints were getting harder and harder during 2022. Might have been easy for households and businesses to absorb the message, but it was quite easy for central bankers to justify their actions. Now we are in a situation where we've clearly gone through the inflection point on both headline and core inflation, and they've got to use the judgment. Specifically, I highlight in the note the degree to which there is spare capacity left in the domestic economy in the United States, in Europe, but around the world economy. Right. The note I wrote back in early December, which speculated there might be quite a considerably bigger output gap in the global economy than those headline workhorse output gap indicators the unemployment rate might suggest. I think to Jonathan's point a couple of minutes ago, have we seen data start to support that narrative? I think we have, and central banks now have to make a judgment on how persistent those upside surprises are going to be.
How has the glide path of disinflation changed this week? I mean, there's this simplistic idea of 9% goes down to 2% or whatever, but it comes down to a point where it stops. How did the stoppedness at 3 or 4% change this week?
Well, I'm not sure a lot of the data you can go with compelling conclusions on. I think when you look at US retail sales, for example, the degree to which both the timing of the cost of living adjustment for Social Security checks, the warmer weather in the United States, how much that was, if you like, giving an overinflated view of the underlying strength of the consumer, and therefore the persistence of that core sticky inflation persistently above 3-4%. We've also got with CPI the degree to which actually it's well understood now the Fed are discounting the shelter element of it, but there are other parts of the core inflation index on consumer services which still look like they're tacking closer to 3.5, 4 rather than 2, the kind of level we'd be comfortable with. So I think the data hasn't necessarily compellingly changed that narrative. I just think the bond market is starting to listen to central bankers in a way that they had their fingers in their ears for the first 8 weeks of the year.
You did a great job, Simon, of highlighting the dissonance between the economic narrative that we're heading into some sort of decline and the commentary that we're getting from a lot of executives, whether it's in Britain or whether it's through the rest of the world, of optimism, of projecting strength and ongoing resilience of consumers. Which is right?
Well, this is to the very point of having to take a judgment, the degree to which corporate US, corporate Europe is giving a relatively upbeat message, and some of the notes I put out 2-3 weeks ago on earnings revisions certainly suggest that the corporate environment hasn't seen the levels of pain that central banks thought they need to introduce, they need to introduce to bring down core inflation. And yet, particularly on a distributional basis, we do know that there are cohort strata of consumers that are under huge pressure, the type of consumers who have a disproportionate amount of their consumption allocated to food and to energy. There's a narrative there which is decoupling from underlying performance of the corporate sector, and central banks have to navigate that and mindful that it's deeply political, the distributional impacts of their decisions over interest rates.
There's a really important point here, Simon. How much do you get a segment of the population just wiped out essentially, or really in hard times while the rest of the population manages through and even succeeds to build earnings and build savings? How much is that basically a feature of what is going to come versus the beginning phase of a broader downturn?
You're absolutely right in terms of this is a very uneven recovery. And one of the reasons why the International Monetary Fund, the IMF, certainly for the last 6 months have been talking about the fiscal authorities, which initially in the pandemic recovery were quite holistic in terms of, quite universal in terms of their support to corporates and households in terms of fiscal transfers, looking to be far more targeted, because I think the IMF and others recognize quite an uneven distribution of excess savings, of facilities to re-leverage. The degree to which it's macro significant is the challenge for a macroeconomist, because a lot of corporate Europe, corporate United States hinges on the consumption profiles of socioeconomic groups A, B, and C1, and therefore to some extent, the underlying earnings performance of a lot of corporates isn't actually hinging on those quite difficult redistributive messages, which are really focusing the minds of politicians.
Simon, on disinflation, we've seen it in America. We're on a path of some form of disinflation. I don't see it in Europe with 10.1% or 9%. You pick the number. But do you assume when Europe disinflates, it disinflates in the same way as the United States?
With a lag. So one of the structural differences between the European economy and the US economy, and this, if you go back through the history, probably the last 30, 40 years of economic cycles, the US tends to have an approach of letting economic forces rip, letting the pain come pretty quickly, and then it dissipates pretty quickly, and therefore more of a sort of V-shaped recovery in terms of economic activity, but also, if you like, an N-shaped pullback on inflation. But because there have been so much, if you like, neutering forces in the European economy, that slowdown of disinflation comes with more of a lag. And therefore, I don't see disinflationary forces overshooting to the downside, because as particularly the headline inflation picture improves, you're going to see some of those suppressants that the fiscal authorities have put in place start to be eased and, if you like, squeeze inflation back into the European economy. I think that's the big difference over the two sides of the Atlantic.
Hey, Simon, this was great. Just the perfect guest to have this discussion with. Simon French there of Pamela Gordon. Simon, thank you very much. I think Steve Englander of Standard Chartered in the last couple of months provided a really good framework to discuss some of these issues. When he talked about the Federal Reserve moving away from non-conditional hawkishness to conditional hawkishness. And when we had non-conditional hawkishness, it basically meant the absolute data is a problem. We don't care about the change. We're going to keep on hiking 75 basis points.
Up the level.
When you saw that shift to conditional hawkishness, Chairman Powell started to interpret the incoming information as somewhat more dovish by saying things like the disinflationary process has started. And then the data started to turn in the month of January, and it's really January that introduces that conditional hawkishness, Tom, and it's returned.
Right, well,
so I'd imagine the Fed speak's going to change markedly if we get a repeat of the January data. Now, it's easy for me to say, TK, because I'm not in the market. I'm not in the market, so I can say, too early to draw conclusions, wait to see if the February data confirms what we saw in January, but other people have got to make moves.
One analog is a bathtub where you've got water in a bathtub and you got water flowing in, flowing out, whatever. That's the idea of the rate of change, the movement, which is where we were. It's easy. Rate of change, rates up, easy, easy. Now we're at a point where levels really matter, and that's why I love what Simon said there is now the hard bit. I mean, it's really what we click into as we move to the March 22 meeting.
How does this really undermine, to your point about how, I have the luxury of sitting here talking and I don't have to make a call, right? And that's a huge luxury. How does this factor into some of the trades that really were the dominant ones, including the stronger dollar trade earlier this year? If you suddenly have data that really question whether the Fed was right to shift its focus on balance of risks. Robin Brooks of the IIF came out and he said the euro is going to go back below parity. He sees that. He thinks that you're going to totally unwind all of this.
Wow, that's a call.
That's
right?
That's what we call a big figure call.
That's the kind of call you can make if you're not in the market, right?
Well, I just, talk about, spitballing it. Yeah.
That's a major call. Helene Becker's going to join us shortly on the airlines. Look out for that. Did you hear about the airline that came from New Zealand, from Auckland?
No.
In the air for like 5-6 hours.
Yeah.
And then couldn't land at JFK, so had to turn around and go back to Auckland.
They couldn't land someplace else.
No. Yeah, what was that headline? 16-hour flight to nowhere.
As far as I understand it, they didn't want to land someplace else because they thought that would disrupt the schedule elsewhere. So they had to go back to Auckland. I mean, just amazing. I'll pick up on that story in a moment. Futures down by 0.7. This is Bloomberg.
Is a crazy story. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. President Biden is trying to keep the dispute over the Chinese balloon that was shot down from escalating. He says he expects to talk soon with Chinese